Alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Good morning, everyone. Stock futures relatively flat after a slew of retail reports signal a mixed read on the consumer. Investors now bracing for preliminary revisions to labor data and the release of the minutes from the latest Federal Reserve meeting. All of this, of course, coming ahead of Friday's Jackson Hole remarks. So let's get to it. As you've got your countdown clock for Jackson Hole, we've got three things that you need to know to start your trading day. Yahoo Finance's Brian Sazi, Madison Mills, and Rick Newman have more.
A tale of two large retailers. Shares of Target are surging after reporting a whopping 39-cent earnings beat after the retailer cut prices on 5,000 products. And CEO Brian Cornell tells me the consumer has responded to those price cuts. Meanwhile, Macy's reports another quarter of declining sales as shoppers put off buying non-essential items. The company is now doubling down on its turnaround strategy a month after turning down a $6.9 billion buyout offer.
Plus, sticking with those retailers, Walmart sells its entire stake of JD.com. Shares of the Chinese-based e-commerce company are under pressure this morning. Now, Walmart had raised over $3.6 billion through that sale as the U.S. retailer plans to shift its focus towards its own operations in China. That's according to their latest SEC filing. Now, this is a sign of Walmart's faith in its own ability to take up more market share amongst Chinese consumers, which could contribute to further growth in the company's international sales.
And we've wrapped up day 2 of the Democratic National Convention in Chicago. It was another night of fiery speeches, with former President Barack Obama and former First Lady Michelle Obama being the big headliners, delivering strong endorsements in support of Vice President Kamala Harris's presidential candidacy. The Obamas were not shy targeting Republican nominee Donald Trump and his policies. Here's what Barack Obama had to say.
Donald Trump wants us to think that this country is hopelessly divided between us and them.
Day 3 of the DNC will kick off later tonight at 6:30 p.m. Eastern. Former President Bill Clinton, former House Speaker Nancy Pelosi, Transportation Secretary Pete Buttigieg, and VP nominee Tim Walz are on tonight's agenda.
Our top story this morning, two retailers, Target and Macy, staying cautious a bit on the consumer as the consumer remains strained. Target shares are soaring on better than expected results. It's a welcomed improvement after last quarter's warnings about inflation-battered shoppers. You're looking at gains of just about 16% in the pre-market. But once you dig into the numbers, there are some signs that the consumer is showing some cracks. The shoppers are spending, but they're still hunting for value. And then we've got Macy's. It's another quarter of declining sales, and that's sending shares lower here this morning. That's off nearly 10%. In the earnings release, CEO Tony Spring calling the results, quote, strong in a, quote, challenging consumer environment. Here to discuss, we have our very own Yahoo Finance executive editor Brian Sazi, along with our senior reporter Brooke DePalma. And guys, lots to get into here when it comes to these retailers and exactly what it tells us about the consumer. But Saz, would love to hear your biggest takeaways on Target.
I'm inflation battered. I paid like through an arm and a leg for like air fresheners at Target a couple weeks ago. We'll take that offline. It's just really a lot to unpack there. But anyway, the shares of Target, top ticker on Yahoo Finance this morning, as the team mentioned here. And this quarter did make sense. Let me tick through a couple of reasons why or what I saw in this report. I think the consumer was choosy in these latest results from Target. Sales did improve sequentially. Target's traffic did increase. The company cut prices or started to cut prices in May on 5,000 daily essentials like meat and bread and milk. Consumer responding to that, CEO Brian Cornell telling me. And then also number 2 here, again, like I mentioned, lowering prices and discounts are helping. Now, Cornell did not say if he was going to take those price cuts down even more or expand them in the coming quarters. I put that question to him, TBD, as they would say. And last but not least, this report might be the first indication the holiday season, which of course will come up against right around the presidential election, may not be a disaster. Now, Target did not comment or discuss how back to school has started, but we have gotten some indications for some retailers that the back to school shopping season has started off good. We heard that from Walmart. Has it started off gangbusters? No. But I think you'll see some more upbeat commentary on the back to school front. From the likes of specialty apparel retailers like an Abercrombie & Fitch when they report in the next 2 weeks. And then you can start thinking about the holidays may not be that bad.
All right, and we're also tracking here, of course, as we're watching shares of Target, we're watching shares of Macy's here this morning. Ticker symbol M. Brooke is looking into this one. What are you seeing there?
A little bit of a different story, but the same trend that we're seeing overall is that consumer discretionary spending is still under pressure. That's what Macy's CFO told Yahoo Finance this morning. We did see softer sales that even Macy's expected. In the quarter was down 4%. And what they're saying is that luxury consumers are not immune to this trend. Their luxury business, Bloomingdale's, saw same-store sales growth drop 1.1%. CFO Adrian Mitchell telling us that the reality is that a luxury consumer has the dollars to spend, but they're not immune to being discerning about how they're thinking about spending. And this is a bigger story. Department stores are really struggling to move forward into the future as the rise of, say, Walmart's marketplace and Amazon are really on the table here. We did hear from them that their first 50 stores where they're really investing in digital, they're investing in checkout technology, they're putting more handbags and purses and shoes. They seem to be doing okay. Same-store sales for those first 50 stores where they invested are up 0.8%. The CFO telling us that attraction is very clear. And that traffic and conversion, these first 50 stores, gives it the confidence to expand a new assortment of handbags and shoes to another 100 additional stores this fall. But on the back, this comes after Macy's decided against a buyout offer of $6.9 billion. They ended talks with ARC House management earlier this summer. They believe that with this bold new chapter strategy they have in place, it will then bring them above the premium value that ARC House did offer earlier this year.
And I also wonder, just in terms of, and it's still early, we still have to hear from a lot of retailers this season, but when it comes to the have and have-nots with the consumer, when it comes to the fact that they are pulling back on spending, I'm wondering if this environment is going to make the gap between the winners and losers even wider. When you talk about those that are working, clearly taking a look at Walmart with it at record high levels versus those that have been struggling for so long. Macy's one of those names, and a handful of other department stores that can't really turn it around.
Yeah, an easy comparison could be this. So we heard from Walmart last week. They had strength in apparel. Target saw a comeback quarter in apparel, strong area. Where could this business be coming from? The likes of a JCPenney, maybe a Macy's. Could you see a strong results out of a TJ Maxx because consumers are looking for deals? Maybe Ross stores? Yes, absolutely. So that's point number one. Point number two, and really the story of the morning, it goes to Brooke. The story is blowing up on YahooFinance.com right now. The theft. Yeah. It looks like inventory shrinkage or theft inside of Target stores has now peaked, and that is the Target executives telling us that trend might get better. That could be a big thing. So I think that's something all investors need to watch, because if theft is starting to decline in stores, maybe as prices start to come down, consumers are feeling okay, they don't need to lift a pair or just try to leave a store with a free pair of razors or whatever it is. That could be pretty good or profit tailwind to many big retailers.
Well, it comes back to a value conscious and a value hacking consumer right now. And it's actually showing up in both of these reports and included in what you were just mentioning in TJX, which actually shares are rising here right now by about 5% pre-market, raised guidance and ultimately giving better than expected results there. So that's one value hack. Looking for some of the logos that are a little bit more discounted at a TJX, at a Marshall's, Home Goods, whatnot. And then additionally, you look at the digital side of these businesses too. Macy's digital and Target digital, both of those climbing. And why? Because people are comparison shopping online. And if you look at when these quarters would end, well, it also factors in that big Prime Day mix that everybody was trying to annex themselves onto and have their own deal days, as one of them calls it. And I forget all of the different kind of marketing spin they put around it. But it's essentially just them saying, hey, Amazon's doing this thing, so we're going to latch on and try to do our own big deals days. You would think that would cut into margins a little bit more, but as of right now, at least, it's something that investors can look at as a positive for the digital side of their business.
Yeah, and I think more consumers are also going in store and looking for those deals. What we heard from TJX is that their foot traffic at all their major brands, like a Home Goods, like a TJ Maxx, they're seeing more people go in store. They're sifting through the shelves. They're looking for the best deal, and they're ultimately buying it, say, over going to a Macy's, or perhaps they're shifting to Target or Walmart to get that better deal.
No, I was just still thinking about the theft comments, right? And Brooke, you wrote about it this morning.
I
guess what I'm wondering, is this more of a Target-specific issue, just in terms of the fact that they are able to get a better handle on it, or are we also seeing other retailers get a better handle
well,
on it as well?
we've heard earlier this year, the Dollar General closed 12,000 checkouts, self-checkouts that is, in order to help this issue. In addition to that, we also actually heard from TDX, their call probably underway, but what we heard from them last quarter is that they introduced personal body cameras on their security officers when you get out the door in order to prevent this theft. They think that by adding those video cameras, body cameras, that ultimately then it will prevent people from doing. Well, that's what we're hearing now, is that they do expect it to be flat, and that we sort of have hit this plateau where all these initiatives are being introduced and they seem to be working.
And even anecdotally, too. I went to CVS across from our New York City office yesterday. I needed some eye serum. It was locked. You had to press a button and you had to wait for an attendant to give you the $40 bottle of eye serum to me. So I wasn't going to walk out with it, and then they followed me to the register. So just new systems and new process. Nobody loves having eye serum and various daily necessities. Eye serum's not a daily necessity, is it? Whatever it is, it's behind a lock. It's behind a lock and key. So people realize when they go into the store, they're not going to be able to lift that item and go out. They have to ask for a human walk you to the front of the store, they see you check out, and then you leave. I mean, you can't walk.
Well, it is reassuring to investors then that this is working, because I think the big question the last couple of quarters has been whether or not some of these initiatives are actually going to pay off and let them get a better handle on this.
As long as they don't stick my tomahawk steak behind a lock and key. Don't do that.
It's cumbersome, but then when you see the product in stores, you're happy that they did this, but it is a little bit frustrating for consumers.
Just want my eye serum, Brooke. I just want my eye serum.
Eye drops, tomahawk steaks, got it, noted.
All I know is the plexiglass companies are up by 1 million right now. All right, Sazi and Brooke, thanks so much for taking the time here with us this morning. We're continuing to track those earnings, plus this other big story that we're watching this morning elsewhere in retail. Walmart unloading its entire stake in JD.com, one of China's biggest e-commerce companies. The sale ending an 8-year partnership for the two companies. Shares of JD.com are sharply lower this morning. Right now, you're taking a look at Walmart shares up by about 1% pre-market here. But this, I think, as we've seen some other moves, even at the start of this week and late last week, of companies looking across where their major investments are, figuring out where they can offload some of those shares to shore up capital, at least in this near term, to put towards some of the initiatives that they're selling investors on.
Yeah, to me, I think this just speaks to the broader, the more macro picture that we're seeing out of China, right? We talk about the property crisis. We talk about the fact that the consumers there are weakening. We talk about the fact that the rebound much slower than what had been forecasted here. And what Walmart has seen worked in China is Sam's Club here. So the thought here is that following this move here from Walmart, the fact that they are selling their stake, did sell their stake in JD.com, they are going to focus on their own initiatives. And what they're doing, they're doubling down here on warehouse business, their Sam's Club business in China following this stake sale. And Sam's Club, that franchise, has been a bright spot here for the company here in the U.S., also oversees some of the traction that we have been seeing. So they're making this bet that they can do it better by going alone, and they don't need this sort of partnership here. So I think this more so gives us a better sense maybe of where the priorities stand, or maybe a better sense of some of the spending patterns that we're seeing inside China, and what Walmart is now banking on is going to work here over the next several years. All right, well, the Obamas bringing the heat on the second day of the Democratic National Convention. Former President Barack Obama and former First Lady Michelle Obama having a fiery choice of words for Republican candidate Donald Trump. So why does this all matter, and how could this impact the election? Here to weigh in is Yahoo Finance a senior columnist, Rick Newman. And Rick, when we talk about whether or not the Obamas were able to sway those voters that maybe are undecided at this point, what do you think? Is it going to make a difference?
I don't think that's the point of the convention, really. I think what they're doing, and they're doing pretty well, is generating a lot of excitement among Democrats. So in order to win in November, either party, you need to do two things. You need to get maximum turnout from your own people, and that's what's going on here at the Democratic Convention, getting people really excited and engaged. And then you have to convert some of the people in the middle. So this is part one, getting Democrats really excited, and it does seem to be working. I mean, it's been a star-studded lineup. It will continue. It will continue tonight with Bill Clinton and Nancy Pelosi, and the Democrats are getting themselves pumped up. That's the main goal this week.
And so, with that in mind, how does this translate into campaign dollars, funding raised ultimately to deploy towards even more of that messaging beyond the week of the convention?
Right, that's a good point, Brad, because along with enthusiasm comes money, and that does seem to be happening. I mean, Kamala Harris has kind of been blowing the doors off in terms of fundraising. That is continuing. One of the questions, and we talked about this earlier in the week, is whether Kamala Harris would get the traditional convention bounce out of this. And I was a bit skeptical because she's already gotten such a big bounce that it seems like maybe she had been pulling that bounce forward. Now I'm guessing this convention is going quite well, and there's more to come. I'm guessing maybe she will get the convention bounce, a couple of additional points up in the polls, and she is now tied with Donald Trump in some polls and slightly ahead in other polls. That's not good enough. She needs to be doing better than that to feel like she has a real good chance of winning in November. But this convention is doing its job so far. And one other thing I would point out, not being overshadowed by protests outside the United Center over the Israel's war in Gaza. And that has been a concern for Democrats all along. We're going to get another protest tomorrow, it sounds like. But so far, it's going Democrats' way.
All right, Rick, thanks so much for breaking that down.
Hey, guys.
Coming up, Ford cutting back on its EV plans. We're going to break down the top trending movers next. And a deep dive into the consumer analyst reaction on how to play the retail sector following mixed results out this morning from Macy's, Target, and TJX. We got that for you when we come back.
Let's get to some trending tickers. It's all about the retailers this week. TJX shares, you're seeing them on screen move higher after the company beat analyst estimates on both the top and bottom line. Plus, they raised their full year guidance. Take a look at shares right now. Pre-market up 7% here. And you can go net sales by division here and see increases across the board for what they call Marmax. You can think of that as Marshalls, essentially, combined with TJ Maxx Home Goods, TJX Canada, TJX International. All of these seeing second quarter fiscal year 2025 reported sales growth, single-digit percentage, high single-digit percentage for Marmax. And it just points back to a consumer that is looking for, as we were discussing earlier, some of those value hacks right now. And look, I'm one of them too. I'm trying to find them deals. Why not?
Yeah, and TJX has a lot of great deals, and that's why we're seeing them being able to take more of that market share from retailers, especially when you stack it up to some of the underperformers that we have seen over the last couple of quarters. So this is very much a continuation of the thread of the story that we have been telling here all season here on Yahoo Finance. The fact that, yes, consumers are still spending, but they're out there looking for deals. And what that really highlights is a consumer under pressure. And because of that, you have these discount retailers like TJX that are beating expectations, that are able to raise their full year guidance in a very uncertain macroeconomic environment. And then you compare that even to what we saw from Macy's this morning, the disappointment there, the struggle that we've seen from so many department stores here as they are trying to do everything they can to lure consumers back in their stores at a time when really the priority here is discount. So very much is the continuation of the story, and also why we've talked to so many analysts recently who have been saying that these discount retailers are those that are best positioned in this environment. So again, you would think that this is a trend that very much is going to stick throughout this earnings season. Let's take a look at Ford, because the company is cutting back on its EV plans. The company announcing it's going to delay a EV plant and canceling plans for a 3-row EV SUV. Yahoo Finance's Pras Subramanian has the details for us. Pras.
Yeah, Shauna, Ford sort of revamping its EV strategy here. Like you mentioned, they're going to cancel that upcoming 3-row EV SUV, that large, almost they called it sort of like a bullet train SUV, meaning it's going to take a $400 million charge on that project and possibly another $1.5 billion on additional costs, so nearly $2 billion there in charges for canceling this project. This as it pivots more towards hybrid technology for that upcoming SUV. Also, they're going to delay their full-size Project T3 pickup by 18 months. Now that's going to be built at its Tennessee plant in 2027. And its Skunkworks team, this little small team based in California, tasked with making cheaper EVs. They're going to make 2 pickups. They're going to make a small, mid-size pickup, and they're also going to actually use some of the designs there for the Project T3, which I just mentioned, which will be based on these Skunkworks designs. Ford CFO John Lawler on a media call this morning said that this was in response to customer needs. They need to be more nimble. The company's targeting to make their cost structures more efficient for these vehicles, and that means they want to have profitability in the first 12 months of launch, and they just couldn't do that with that 3-row EV SUV.
All right. Pras, thanks so much for breaking this down here. We're tracking all things ticker symbol F pre-market. They're holding on to some gains as of right now. Appreciate it, Pras. Let's stick with the automakers here. Tesla is recalling over 9,000 Model X sports vehicles over a trim on the roof that could separate and increase the risk of a crash. This according to the National Highway Traffic Safety Administration. Tesla recalled nearly 2.6 million vehicles due to safety concerns in the first 6 months of the year alone. The big differences here with these recalls is which ones can be fixed via an over-the-air update and which ones involve a trim that you might actually need to take into a service center to be able to have fixed so that you don't run into these unfortunate issues that the National Highway Traffic Safety Administration, NHTSA, as some people know it, has flagged.
Yeah, and I think as of August 14th, they're saying that Tesla said that it has identified 40 warranty claims, 6 field reports, 125 service reports that may be related to this defect. They also added that they are not aware of any collisions that have happened, injuries or deaths caused by this defect. Now, it is important to point out that affected drivers have been notified here over the last several months here, just since this initially came to light, since the voluntary recall that we did see going back here a couple of years. So again, this is just the latest development within this within this recall story, excuse me, because there's so much retail news out today, but within this recall story, over 9,000 Model X SUVs now being recalled, all according to reports here, Brad.
Yeah, and let's remember here, I mean, the Model X really accounts for such a small subset of the total production and deliveries that Tesla is continuing to move forward as of this point in time. I mean, just look at the most recent second quarter delivery figures here. And this is really just kind of bundled in under that other models, whereas the 3 and the Y, they make up the lion's share of the 443,000 deliveries, 443,000 plus deliveries that they made during that quarter here, whereas for the X, the S, and then the Cybertruck. All of them essentially accounting for 21,000 of those. So you can do the math on that one. You've got the calculators. I've just got a laptop here in front of me. Calculator in its own right, I guess.
There we go. All right, well, we're just about 6 minutes until the opening bell on Wall Street. Keep it right here. We've got how the trading day is shaping up. You're looking at gains across the screen here. Dow, S&P, and Nasdaq all on track to start the trading day to the upside. We'll be right back.
Originally inspired by General Motors ending its EV1 program, Tesla has become the world's leading electric vehicle manufacturer. In 2023, Tesla generated nearly $97 billion in revenue, and its market cap is over $570 billion. The company was Yahoo Finance's top trending ticker of 2023, with over 300 million page views. Let's take a look at some of the company's biggest moments with Beyond the Ticker. Originally named Tesla Motors, Tesla was founded in 2003 by Martin Eberhard and Mark Tarpenning. Elon Musk joined the company in 2004, investing over $6 million of his own money and becoming chairman of the board. In 2006, Tesla unveiled the prototype for its Roadster, which entered production in 2008. It was the first all-electric car to use lithium-ion battery cells. After co-founders Eberhard and Tarpenning left the company, Musk took over as CEO in 2007. On June 29, 2010, it went public via IPO on the Nasdaq at $17 per share. In 2016, Tesla unveiled the Model 3, its first mass-market vehicle. Later that year, Tesla agreed to acquire SolarCity for $2.6 billion. On July 6, 2017, Tesla stock crashed after delivery concerns. The company lost more than $12 billion. Defying expectations, Tesla recorded 4 profitable quarters in a row from 2019 to 2020, making it eligible for inclusion in the S&P 500. On November 4, 2021, the company reached an all-time high stock price of $409.97. Originally introduced in 2019, the first Tesla Cybertrucks were delivered to customers in November 2023. Tesla continues to produce despite its setbacks due to lawsuits, manufacturing delays, and Musk's controversial statements. Investors will continue to wait for the next wave of innovation from the world's most valuable automaker.
All right, that was the opening bell here in the U.S. as trading has commenced. The NYSE, you've got Chelsea Football Club ringing the opening bell there. Not American football or football American, it's soccer. And we've got at the Nasdaq, V ringing the opening bell there. Some virtual funfetti. All right, great group, bunch of folks on both sides there that you're seeing there. A lot of jubilee to start the day. I don't know.
A lot of happiness, a lot of excitement, and we love to see it on this hump day on Wednesday. All right, let's take a look at the at the major averages here. You're looking at gains. It looks like across the board, at least for now, obviously very early in the trading day, but at least in terms of where we're opening, we've got the Dow opening up just about 100 points. You've got the Nasdaq adding to those recent gains, up another 0.1%. You've also got the S&P 500 now back above 5,600 level, again, a key level to watch here in the trading days going forward. Taking a look at the bond market, you're seeing a bit of a pullback here in yields off just about 2 basis points. And taking a look at the sector action here in terms of what is leading today, lots of green on your screen. You got consumer discretionary, consumer staples among the outperformers. On the flip side, communication services, technology, not too far from the flat lines here. You've also got real estate trading to the negative side.
Yeah, I'm just going to take a quick look at the Dow components here. A little new thing that we're doing. Why not switch things up a little bit? We've got Walmart leading the pack right now, some deep green, and that's a good thing. It's up by about 1.2%. Also, digital retail catching a bid here on the day. Amazon, that's up by about 1%. Also could be a cloud play. It's got so many different businesses. Could be anything on any given day. But more green than red. That's a good thing here as we'll continue to track what some of those moves in retail look like this week.
All right, let's kick it over to Jared Blickery. He's got a closer look at some of this movement that we're seeing. Jared.
That's right. Nice look at Papa Dow there. I want to take a look at the S&P 500, and let's just dial that up. This is a 4-day look. I'm going to put a year-to-date so we can see these record highs right there, and I'll put a line graph so you can even see it better. We are right there at those highs, so just a little bit higher, we'll be saying record highs. But before we get there, let's just take a look at the Nasdaq. Nasdaq has a little bit more to go. It has been clawing back those gains at a faster clip than the S&P 500 and the others. We'll have to see if that continues. But one thing I have been noticing, here's the VIX, and here's that big spike we got on an intraday basis. It was all the way up here in the 60s. It is now up 2 days straight. So that's not enough for a trend just yet, but it's something we watch out for, because a lot of times what the VIX will do, it'll spike up, then it'll wait a bit, then it'll spike up again, and then those spikes will keep getting smaller and smaller. But each time you do that, you still have a little bit of a pullback. So we just want to know when and where that next one is. Not necessarily imminent, but something we want to follow and keep close tabs on. So today's sector action is really about retail. We have both staples and consumer discretionary, the stuff that you need and the stuff that you want. Both of those are leading up about 1% or 0.9%. Energy, after having kind of a rough day yesterday, that's in third place. Only communication services is in the red, but I want to show you the Nasdaq 100, and let's see if I can find Netflix here. Lots of components here. Anyway, Netflix was able, and here it is, was able to reach a record high for the first time since 2021 only yesterday. So this is a stock that lost, I think this was something like 75% of its value, just an incredible steep loss, and it is finally reclaimed that. So an old FANG name to celebrate return to highs. So I'll leave it on that, guys.
All right, Jared, thanks so much for breaking that down for us here. Just about 3 minutes into the trading day, and we're looking at gains for today. As of this week, the Mag 7 gaining more than $1.6 trillion in market cap since August 5th. That's nearly half of what the S&P 500 has gained in that same period, over $3.6 trillion. After the market rout hit mega cap tech as recessionary fears and the unwind of the carry trade pushed markets lower earlier this month. But when you take a look at today's movements to the upside, take a look at the rebound that we've seen. What should we prepare for going forward? Bringing in our next guest, we want to talk about all of this movement with Keith Lerner. We've got Truist's co-chief investment officer and chief market strategist joining us. Keith, it's great to see you. And I know that you specifically have been looking at tech. You got a bit, not bearish, but you were saying that we were ready for a bit of a pullback. And now you're back saying that you like these valuation levels. What does that signal just in terms of the market leadership that we could see?
Yeah, well, great to be back with you. Actually, you and I and Brad were together on that Monday opening when the VIX went up over 100%. So, 2 weeks later, here we are almost, 1% away from all-time highs for the market. So going specifically to tech, we downgraded tech at the end of June because we thought it got stretched on most of our metrics that we looked at. And then during that same week that I just mentioned, on August the 8th, we upgraded tech because in our work, it went from the best 1 month outperformance in 20 years to the 1 month worst underperformance in 20 years. And all that correction in our work was just repositioning. The earning trends for technology is at a 52-week high. So our main focus is that we still think tech is leadership, and we think that AI story is still intact. So that at this point, we are back to overweight, again, doing that earlier this month on the pullback.
Keith, I do not have enough Dramamine for all of these moves that we've been tracking. We're seeing VIX spike, and then of course we see the sell-off, and then now we're back at these levels where we're talking once again about being in the ballpark potentially of all-time highs for the major averages here. As you think about what investors should be doing to diversify, even if they are trying to ready their portfolio for what some of your other industry colleagues are saying, hey, brace for another potential downturn, where should that diversification lead them?
Yeah, it's fair. Now, the first thing I'll just say, the pullback we've seen in off the low, I mean, the peak to trough decline was about 8.5%. If you look at it historically, after strong first halves, you normally see a correction of about 9%. So that was pretty good, pretty consistent with history. You also tend to see 1, 2, or 3 other corrections by the end of the year. So I think we'll likely have another corrective period. But I think here's the important thing, is that we're in a bull market. The primary trend is still positive. You want to stick with that primary trend until the weight of the evidence shifts and use pullbacks as opportunity. And then answering your question more on the diversification side, I mean, we invest globally. We still like the U.S. We're still Team USA. We still prefer large caps over small caps as a whole. And then outside of that, we think high-quality bonds are acting like bonds again. So we like bonds, even though we did cut our duration more recently as well. And then lastly, I'll just say, we do have, just for the diversification, we have a modest position in gold as a hedge, which is actually making, all-time highs right now.
I'm just going to piggyback off of that. Keith, you said that you at Truist are still Team USA on the investment perspective. Who is the analogous Steph Curry? What sector is the analogous Steph Curry, or even some of the specific names within themes that you're tracking across this investment thesis right now?
Yeah, so I kind of gave it away earlier. We're still, we're overweight tech, we're over communication services, and we're overweight utilities. Utilities is a play on somewhat low interest rates, number one, a little bit of an AI play, and also somewhat of a cooling economy. Also, I will say that more broadly, you talked about this. I mean, we are seeing other areas participate. Financials, industrials, staples also are doing well. So I think the market will have broader participation, but we still think the magnificent seven and the technology is still leadership. So we still think that's the Stephen Curry, but like the Team USA basketball team was pretty deep and broad, and I think this market is you're seeing better signs of that right now as well.
All right, you got your answer.
Thanks for playing along, Keith. I appreciate that.
Brad did a whole fist bump right when you got to the final line there. But Keith, let's talk about something that could really move the markets today, and that's about 20 minutes from now. We're going to get this revision here that will tell us or give us a better idea maybe about the strength that we had seen in the labor market. What's at risk for equities? If we do see a massive revision here to the downside, what does that then mean for the equity market?
Listen, it could on the margin have a difference, but the reality, it's backward looking. And when that employment report came out on that Friday before that plunge we saw at the beginning of this month, what we said to our clients then is, don't overreact to one number. This number gets revised 3 times. And now we have benchmark revisions, which are revising all the history. It's almost like if we had that data in real time, we wouldn't have reacted so much to all these different numbers, because numbers that were at one point showing 100,000, all of a sudden in history, now it's 300,000. So I would say I think the Fed and the market is going to be focused on forward indicators. Initial jobs claims is going to be a more real-time tell. The comments we're seeing out of retail this morning from Target saying we're seeing some acceleration in discretionary spending, I think is a change of tone. Walmart saying, hey, we aren't seeing consumers fraying. So I think from a market perspective, the commentary out of companies is more important than the benchmark revision that we see today. It could, on the margin, help influence the Fed, but I don't think it's a game changer.
All right. Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist. Keith, always a pleasure to grab some time with you after the opening bell. Thanks so much.
Thank you.
Coming up, a mixed read on the consumer here. We'll have analyst reaction on the latest earnings from Macy's, Target, and TJX on the other side of this short break.
Target, or what some have nicknamed Target, has seen its fair share of ups and downs in retail as a 6-decade-old company. Beyond the Ticker takes a deep dive into the retail giant's biggest moments. The first Target discount store opened in 1962 in Roseville, Minnesota. It was owned by the Dayton Company, which also had a well-known department chain store called Dayton's, but the two stores were competitors. Fast forward to 1990, the first Target Greatland opened in Apple Valley, Minnesota. 50% larger than a standard Target store, Target Greatland included wider aisles, additional food options, and more efficient checkout lanes. 5 years later, the first Super Target opened in Omaha, Nebraska, combining Target Greatland with an upscale grocery store, Archer Farms Market. Believe it or not, it wasn't until 2000 that Dayton Hudson Corporation was actually renamed to Target, operating under the new ticker symbol TGT. In 2014, current CEO Brian Cornell took the helm, faced with years of weak sales growth and in charge of turning the cheap and chic retailer around. Then in 2021, Ulta Beauty debuted at Target, proving to be a bright spot, luring in foot traffic as customers pulled back on spending in recent quarters. In 2022, Target was one of the first companies to address shrink, aka retail theft. That year, the company blamed the drop in gross margin rate on shoplifting or shrink. Now the big box retailer is thinking to the future, investing in promotions with its Circle Rewards program and investing in its footprint. With its biggest fleet yet, at the end of 2023, the company had more than 1,900 stores across all 50 states.
Target's better than expected second quarter earnings come as Wall Street debates the health of the consumer. The stock has 16 hold ratings, 38 analysts cover the company, so nearly half are rating it a hold. Now, let's compare that to Walmart, which only has 3 holds, just 7% of the 44 analyst ratings. Our next guest says that is actually one of those analysts with a hold on Target and a buy on Walmart. Oliver Chen, TD Cowen Senior Research Analyst, joins us now. Oliver, did you see what you need to from Target to change your rating, or does it change the story for you at all?
Brad, we're definitely encouraged. So comps turned positive at plus 2%. And very importantly, apparel is performing well as general discretionary merchandise. So that's a great thing to see. It's on easier comparisons. Also, Target stock is very inexpensive relative to Walmart at 16 to 17 times PE versus Walmart's 28 times. But the consumer remains choppy. We need to see continued consistency at Target. That's what we're looking forward to. We're hopeful that this is a great sign of more to come. We'll see.
Oliver, what do you think this signals about back-to-school shopping, what it tells us about holiday shopping? You mentioned the fact that you're hopeful that this is going to be the start of a larger trend. Just in terms of the macroeconomic picture, I guess, does that make you a little bit hesitant in the fact that maybe some of those challenges aren't over here for Target?
Yeah, Shauna, so today's a big retail day. For example, the Macy's comps were down 4%. So what we really see is winners and losers. We see a consumer that is willing and able to spend, but they may or may not. And that's really manifesting in a choppy environment. The consumer is still definitely feeling inflation. The consumer also has $700 billion of savings, and the labor market's tight, which is good because unemployment is at a low level. However, credit card delinquencies are up, and the consumer is feeling very stretched. So I think it's a real mixed bag. Back to school so far from company comments has been better than feared. That's very nice as well. And apparel's a tough competitive market. For Target to see some performance out of its own private brands is quite positive.
When we look across the consumer landscape here, one thing that's continuing to come up right now is this value hacking that consumers are looking to do. And you and I have talked about this in the past, Oliver. How far do you see that extending into some of the larger discount retailers and benefiting a TJX versus benefiting a department store that might have to churn through inventory just to figure out what needs to be discounted and what they could still sell at full price?
Yeah, Brad, that's a theme that you know well. Bougie on a budget, customized moderation, trading up, trading down, looking for great duplicates. That's a permanent change, and consumers have more transparency than ever. The real key to success in retail is value, the value ratio to trend and what's being trend right. The off-price market has been an exciting sector that's been constantly taking share. 5 to 10 years of share from Macy's and full price department stores. Consumers want a deal, they look for promotions, and retailers need to be faster and faster at the way they execute, especially relative to Amazon and Shein and others. So being trend right and offering great prices will continue to be so important. Costco's another idea that we like, and Walmart's having more and more competitive apparel offerings.
Is there anyone really, Oliver, that can challenge Walmart, can challenge some of these leaders within this environment right now, or is this gap here between the outperformers and those that are underperforming something that's likely here to persist?
Yeah, what we're really following is tech and artificial intelligence as well. And Walmart is very ahead of that. Scale matters too. So you have mega retailers such as Walmart, Target, and Costco, the big getting bigger. But we'll see. There's pockets of great innovation everywhere. Other stocks that we don't cover include Aritzia and Abercrombie & Fitch, where apparel has really innovated there. So people can definitely innovate. It just depends. But scale matters for things like micro-fulfillment centers, speed to the consumer, convenience, these massive loyalty programs, which drive a lot of engagement. And it's very expensive. Consumers want everything right now, everywhere, through different ways. It's very expensive to play in this competitive environment.
Yeah, it seems like Abercrombie & Fitch, for what you were mentioning, really benefiting from some of the wedding seasons that we're seeing continue to, I mean, look, I've got too many weddings to go to, but I'm happy for all of them. Anyway, all that aside here, Macy's, we were just talking about them briefly. What does Macy's look like from your perspective without a buyout here, without a deal, because we know that they ended those talks with Arkhouse and Brigade?
Yeah, the road ahead for Macy's has a lot to do with innovating private brands and their own portfolio of exclusive product. That's very important for appealing to the younger consumer. The other thing that's happening is small format. So less can be more, smaller stores that are more convenient, and also inventory that's more curated and better service. In addition, better inventory management using personalization tools. And Macy's has very, very high awareness. It just needs to have more of the right product at the right place and the right time. People are looking for fashion inspiration out of Macy's versus very low prices. So the company needs to rise to that occasion. The mall is a tough place to be. They know that. Small format is an opportunity for growth. So we'll see what will happen there, but we're on the sidelines at a hold rating on Macy's.
Yeah, I can't tell you when the last time I stepped foot in a mall was. Of course, New York, a far different picture when it comes to retail here, but maybe I need to get back into a mall sometime soon. If you got any recommendations, Oliver, I'll take them all.
Yeah, we're looking forward to better and better stores. I think it's a tough place. I think food, beverage, experiential. We like Saks, we like Glossier, we like Kith, we like Supreme. Department stores need to bring excitement back and need to bring better service back. And all of this is a recipe for change. Exclusive product will be very important, but beauty is quite experiential. That's performing better, and that's an in-person activity too.
Yeah, make department stores exciting again. We'll workshop it here. Oliver, great to see you. Oliver Chen, TD Cowen Senior Research Analyst. Appreciate the time. Coming up, everyone, we're taking a closer look at what's trending on Yahoo Finance. That's right after the break. Stick with us. We're taking a closer look at Yahoo Finance's trending tickers here this morning. We've got Toll Brothers, Lazy Boy, and SiriusXM. And we're doing it, or we're going to try to do it, in 30 seconds each. We have Catalyst co-anchor joining us, Madison Mills, here at the desk. All right, let's start things off with Toll Brothers here. I once did one of my sophomore high school reports on this. Toll Brothers shares surging. They weren't public, actually, when I did that report. Anyway, shares are up by about 6.5%. The home builder raising its full-year guidance. They beat the street's EPS and revenue expectations in its third quarter report. They cited a resilient economy, favorable demographics, a lack of supply driving the beat here. So ultimately, a few things to continue to keep an eye on for Toll Brothers, though, is the entirety of how they're going to work through not just the backlog, but secure future orders as well, and at what margin. There was a little bit of margin depreciation, so that is something to keep close tabs on going forward for Toll Brothers.
All right, let's talk about Lazy Boy, guys, because shares are sliding. The furniture maker's guidance coming in below the street's expectations. They cited some macroeconomic conditions, consumer spending as headwinds. We're looking at losses of just about 3%. This is the latest retailer here to point to the fact that consumers are pulling back on spending, that the environment remains very challenging here, especially for a name like Lazy Boy. Within this release, their CFO, Bob Lucian, saying that the industry not only remains under pressure in the near term as the market contends with a couple of things. One, the higher interest rates. Two, the muted housing turnover. And then also that uncertain economic and geopolitical environment. So all of that to say that Lazy Boy's tough times might not be behind them yet.
All right, well, let's get to shares of SiriusXM rallying here after Call Her Daddy host Alex Cooper signing a multi-year deal with SiriusXM, dropping Spotify as the show's exclusive distributor. You can see those shares of SiriusXM up 3.8% right now. The deal's valued at around $100 million, could have been up to $125 here. This comes after her deal with Spotify was just $60 million, just paling in comparison to that $125. But she did mention on her Instagram that you will still be able to access the podcast everywhere for folks who want to be able to listen in. Obviously, record-breaking numbers for her in terms of viewership and the payment that she's going to be getting out from this podcast.
That's a mind-boggling number.
It's mind-boggling.
Million. It's crazy. And then it was only 3 years ago when we were all talking about how big of a number that 60 million contract was with Spotify. It also means that people are willing to spend a heck of a lot on podcasts here in order to try to generate some of their user interest and help with some of their user numbers. All right, guys, keep it right here on Yahoo Finance. Coming up next, Wall Street very much on edge ahead of payroll revisions. That's coming out in just a few minutes. Forecasts are for a weaker jobs market than maybe initially read into. So what does this all mean for the Fed? What does it mean for the risk of a recession? We'll tell you next on Catalysts.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Just after 10 a.m. here in New York City, I'm Shauna Smith alongside Madison Mills. It's just after, so here, let's talk about the three catalysts moving markets today. We've got a revised jobs print that could raise the risk of recession. Retailers showing that consumers are strained, and we've also got gold hitting another record high. So here we are, 30 minutes into the trading day. Let's take a look at the major averages. Stocks moving to the upside. We got data crossing now. Consumer discretionary staples, the biggest gainers in the S&P 500 this morning following retail earnings that we got out earlier here. We have Target really surging. You've got Macy's trading to the downside. And of course, this all comes ahead of the jobs numbers that we are expecting to get here, Maddie, as we dig through this release. But again, big questions that ultimately what this means for risk of recession and how much movement this could cause ahead of Jackson Hole in the comments that we're getting from Fed Chair Jay Powell on Friday.
That's exactly right. It leads to a broader question that we've been talking about, which is the health of the consumer. One indication of that is those retail results giving us a picture of that consumer. Executives and economists really split, though, on how healthy spenders are and what that says about the broader economy. And it's interesting given that obviously the street was happy about Target's earnings this morning here as an indication that the consumer is holding up and is resilient against the state of the economy and inflation. But whether or not that's just the street trading on optimism or an actually healthy consumer is a key question that we're going to be digging into with our guests as we go throughout our show today.
And then we also are taking a look at gold because it's extending its rally, holding above $2,500 an ounce here. That level that investors are watching. The dollar remaining weak ahead of Fed Chair Jay Powell's speech at Jackson Hole on Friday. All this tying together. The common thread is the movements that we're seeing in the market ahead of Powell on Friday, whether or not he's going to pour any cold water on the rate cuts that are very much expected. If in fact he might not be as dovish as maybe the market is anticipating or wants him to be, obviously that could be a headwind here going forward. And then also just questions about whether or not a 50 to 25 basis point cut, what would make the most sense? Market obviously very much pricing in 25 basis point cut at this point.
Absolutely. Well, we're going to get to our top story, which is those labor market revisions indicating the state of the labor market. Now, this is a first revision. We're going to get the final revision in February of 2025. The labor market has certainly been slowing. The question is whether or not it's slowing or slow. We've got a panel here to talk with us about the data here. We've got Omar Sharif, the founder and president president of Inflation Insights. We've also got Marco Casiraghi. He is an economist and policy strategist over at Evercore ISI. And guys, I'm going to be honest, on my end, I have not seen these numbers crossing yet, and I haven't gotten clarity from the BLS website. So I am curious. I'm just going to start with you, Omer, in terms of what you're anticipating for these numbers. I know that you think that the street's estimate of either a 300,000 to a 1 million job revision, which is massive, might be an overestimation of the change that we could anticipate for the labor market. What are you thinking as we head into this data?
Yeah, I'm actually sort of kind of in the smack dab middle of those two numbers. I think it'll probably be somewhere around 500 to 600,000. As you said, it should have been out at 10 a.m. We're still kind of waiting to see this number drop. But I think 500, 600,000 is sort of where I expect to see this. We already know we're running about 730,000 below for the last 3 quarters of 2023. I think that ought to get revised up, given some information we know about where the job market has been. But sort of 500 to 600K, I think million's a little bit too much in my book. 300 is probably a bit too optimistic. So I think just right is sort of that 500, 600K range.
What do you think, Marco?
I agree with Omar in terms of the numbers. I think probably low 500 is a good estimate. I hope the BLS will tell us soon what the real number is. But I think, the bottom line of this is that what these revisions do is to take one of the strongest data on the labor market that we had and revise it down. So meaning that overall labor market conditions in 23 and early 24 were softer than we previously thought. But from the Fed perspective, let me bring the Fed into the picture here, is that these revisions were, to some extent, already anticipated. In June, Powell said there was an argument to believe that payroll growth was a bit overestimated. Governors Cook and Bowen made similar comments. So this may change, let's say for the number, but may change the picture only at the margin. And the Fed will remain focused on the next set of labor market data, which comes after Jackson Hole.
Omer, going back to you here, we don't usually pay this much attention to labor market revisions. And obviously the labor market has been a key catalyst for the equities market when we think about the market rout that was caused by a variety of things, but in particular a soft jobs print. Why do you think that we are so confused about the state of the labor market right now? Is it that we don't have good data, or is it that things are changing too quickly?
Well, I think the data is fine. I mean, if we think about today's number, all we're really doing is benchmarking the information we've got for the last 3 quarters of 2023 and Q1 of this year to much more comprehensive data that gives us a much better picture of what is going on. Let's not forget the monthly jobs number is a survey-based estimate. Now, it's extremely accurate for the most part, but when things are changing, when the economy is heating up or when it's cooling off a little bit, it can overestimate or underestimate the way things are going. So this count is really telling us what the tally was for what the more sort of authoritative tally was for the 12 months up to March 2024. But, as was just said, I think the Fed cares much more about what just happened, which is that the unemployment rate has moved up to 4.3%. Don't forget their year-end estimate was 4%, so we've already shot north of that. And history tells us that we need to be more concerned when the rate is rising because it doesn't necessarily just stop after going up 0.5 or 0.6. It can keep moving. So they're going to be much more concerned about that. I think the data is good. But again, we've got claims that are very, very low historically. Continuing claims have crept up a bit. It's more that the unemployment rate has been rising. And we're not quite sure whether that is more to do with this influx of immigrants that's sort of looking for work, but we do know that it is taking people longer to find work and that the labor market has softened. This is really just sort of telling us, was the economy adding 240,000 jobs over the last year into March, or were we adding something more like 160, 170? So it just sort of gives us a better perspective going into what we already know has happened this year.
Marco, real quick, let's talk about ultimately what this all means for Powell on Friday, but also just what you think the signal is going to be. Very much markets are expecting a dovish signal here from Powell on Friday. How likely are we to get that? And I guess, what do you think makes the most sense in terms of the path forward for the Fed up until this point?
We think that, when it comes to Friday, which is definitely the biggest event of the week, Powell will try to send a calming message. I think that the Fed got a glimpse of what a disordered market reaction to recession fears would be earlier this month. So they will tread very carefully looking forward. I think that Powell will deliver the message that the Fed is sufficiently confident that inflation is heading back to 2%, which will allow them to cut rates soon, which soon means September. And it will explain, the framework that will underpin the coming easing cycle. Powell will probably not talk specifically about 25 or versus 50, but it will clarify that, if August unemployment report is better than July, which we think is there's big case now, they will go with a string of 25 basis point cuts for the rest of 24. But it will also communicate that they're open to 50, especially if the August employment report sends signals that are consistent with July. So bottom line, the Fed will deliver the message that they don't want to fall behind the curve, and they're committed to deliver the soft landing. If this means like cutting, by 50 basis points in September and November, they will definitely do it.
All right, Marco and Omer, we'll ask you guys if you guys could please stand by because we'd love to get your reaction to this report that we're expecting on here any minute. But in the meantime, we also want to talk about one of the other big stories of the day, and that is the retail numbers that we're getting out this morning. The health of the consumer seeming to be up for some debate now for quite some time. While most executives and economists are or do seem to agree that spending is slowing, especially in discretionary items, some see this as an indication of a larger economic slowdown, while others aren't expressing much worry. The experts that we've talked to over the past few weeks have had this to say.
The consumer is still hanging in there. They're being choiceful, they're being discerning, they're looking for value and focusing on those things that are essentials versus the discretionary items.
We think the consumer is slowing. We're in the weaker camp.
So there is this mismatch. The top 20% doing very, very well, going to keep spending. The lower incomes households, perhaps the lower 60%, really feeling some financial pain right now.
The U.S. consumer is doing okay, but the U.S. consumer is doing okay because they still have a job. The second that the employment market flips, we think the U.S. consumer, unfortunately, will falter.
So is consumer spending a bigger catalyst for the economy? We have our very own Brooke DePalma here with us. And Brooke, I'm just curious, just your takeaway from this earnings season so far, the commentary that we are getting. What is the assessment of the consumer?
Yeah, well, let's be clear that consumer spending is a key driver for the U.S. economy. And what we're hearing from multiple retailers, whether it be a Walmart or a Target or a Macy's, a slew of them, is that consumers are being more choicey. They're really being more discerning, and they're really picking and choosing where they want to spend their dollars. They're still gravitating towards those essential items like groceries. But then when they do tend to go to apparel a little bit more than what we've seen recently, is that they're looking for value, they're looking for discounts, they're looking for the best deals that they can get. And you take a Walmart who has low prices every day, they're doing well in this environment. And then we heard from Target out this morning that those $5,000 plan to lower prices over this summer really seemed to benefit them. They cut prices on 5,000 items announced ahead of Memorial Day weekend. And so that's playing into their Q2 results. And then you also hear from a discount retailer like TJ Maxx. They're saying that more customers are going to them, that they're seeing higher foot traffic as consumers are really searching for deals in this environment, guys.
I think it's really interesting. Two things that come to mind for me as kind of my big takeaways from this. One is that the discounts seem to be working, and that could be an indication that inflation is going to potentially continue to come down in terms of consumer spending on goods. We are seeing consumer staples hitting record highs today in the stock market side of things as well. But also it makes me think that the street is potentially trading on this idea of a resilient consumer and more resilience than they had anticipated. But that doesn't necessarily mean that it's a strong consumer. To your point, Brooke, you started out by saying the consumer makes up 2/3 of our GDP, right? So it is critical that the consumer stays healthy. And I'm curious to see whether or not we'll continue to see more price cuts to meet the consumer where they are, or if we'll have a consumer that can stand up to any sort of prices moving forward.
Yeah, you think about America's biggest retailer, you think about Walmart, and what we heard on the call from them is that when they introduced Better Goods, it's a $5 price point, it's their new private label brand. They said, hey, we're working with vendors to bring their prices down, because what they're seeing is consumers responding to this very niche price point, this low budget, people really looking for higher quality goods for a lower price. Walmart winning over share in their private brand. And so now they're saying that they're working with vendors to lower prices. When exactly we'll see that happen, well, we have to wait and see. And ultimately, if consumers pull back by continuing to buy less, that really could be a catalyst, so to say, on these big CPG brands to really lower prices in the coming months.
All right, Brooke, thanks so much for breaking that down. We're still awaiting the latest data out from the Bureau of Labor Statistics telling us what exactly the labor market more realistically looks like. Some of those revisions could really trigger some volatility in the markets here today. We've got that for you when we come back. NVIDIA moving to the upside here once again, up just about 1%. We are exactly a week out from its quarterly earnings results. The stock has rallied roughly 30% over the past 2 weeks. Here with more on what the next catalyst could be for the stock, we want to bring in Ines Ferre. And Ines, we're not too far from those record levels here for NVIDIA.
Yeah, that's right, Shauna. Those record levels being at just north of $140 per share that was reached back in June. So we are about $12 off of those levels right now. And we are seeing, as you just mentioned, NVIDIA just above $128. A week away from its quarterly results, which analysts have been anticipating. So what's next for this stock? Well, look, Oppenheimer put out a note earlier this week talking about some of the support, some of the resistance levels for this stock, talking about $120 being a support level here. This is their NVIDIA's 50-day moving average, 106 being another support level. That is a 100-day moving average. And then you've got the $90 level right here. This is the August low. Remember that on August 7th, NVIDIA closed below $100 per share. As far as the resistance, 125, 136 being the resistance level for this stock. Some bullish notes have come out recently from analysts, basically reiterating their bullishness on the stock, on NVIDIA. And with you've got 66
Street analysts that have a buy rating on this stock. 8 hold, 0 sell, $142 price target on the average between all those analysts. A lot of analysts saying that they're not too worried about any reports about a possible delay on their next generation Blackwell chip. Also seeing still strong spending from big tech on data center, guys.
All right, thank you so much, Inez, for joining us. And again, NVIDIA closing near a record high, back from its June record high. So we'll continue to monitor that moving forward ahead of their earnings print. But let's move on to another asset class here, and that is gold. Gold's record rally is consistent with positioning ahead of a recession, according to reports. The 20% rally year to date coming as investors position around rate cuts, lower borrowing costs, and concerns about a potential hard landing. Here to discuss what's next for the asset, we've got Chris Mancini. He's the Associate Portfolio Manager of the Gabelli Gold Fund, GoldX at Gabelli Funds. Chris, it's great to have you. I do just want to start with this idea of why we're seeing gold at such record highs. I know that it's either, hedging against a potential hard landing, but we've also got central bank positioning, institutional buyers, hedge funds purchasing gold at record rates. Is that an indication that smart money is concerned about a slowdown, or is it something more related to monetary policy and the wonkiness of that?
Yeah, I think it's a combination of both, like you said. I mean, I think that we are seeing an increased interest in gold as rates come down, as we are seeing the economy weaken. There's the potential that rates decline. There's an opportunity cost to holding gold, which doesn't have a yield. And so as that opportunity cost declines, we're starting to see interest. So we've seen interest in gold-backed ETFs start to grow as rates have started to decline, as the economy's shown signs of weakness. But there has been this consistent kind of like solid baseload demand from central banks. And that's primarily China. After Russia invaded Ukraine and the United States and Europe confiscated Russia's foreign exchange reserves in the form of dollar, U.S. treasuries and euro-denominated bonds. So China's been buying gold. Other central banks have been buying gold. That's the baseload. But this recent upturn has been because we've had ETFs buying gold as interest rates have declined, as the economy's weakened.
So, Chris, how much of a Fed rate cut has already been priced in? I guess when we're trying to figure out whether or not we're going to see some profit taking from these levels, similar to what we have seen over the last several months following those record high prices for gold, is that likely? Or on the flip side, is this still going to be a catalyst?
I think it'll still be a catalyst. I mean, because what's interesting is that so far this year, we've seen around 3 million ounces come out of gold-backed ETFs. That's out of a total now. I think we're like 82 million ounces. So it's like 3.5% or something like that of all the gold and gold-backed ETFs has been sold just so far this year. And we're just starting to see an uptick. And what we've seen in the past is that these trends, they typically keep on going. So if rates do keep declining, so if we see one rate cut and then that's it, then maybe the rally will stop. But if rates continue to decline after this projected next one in September, I think that we'll continue to see flows into the ETFs, and that'll drive the gold price higher.
So let's talk about the makeup of those ETFs, because it's obviously not just gold that we're talking about here, Chris. And I know that you specifically look at the miners. And for investors listening, gold is kind of the big guy in the room, obviously, but then the miners are kind of the smaller picks and shovels, literally in this case, that benefit from a broader gold rally. Why should investors be looking at miners as an investment opportunity rather than just owning the metal itself?
Yeah, thanks. That's a great question. So that's what we do at the Gold Fund. So the reason is because the gold miners really give you income and growth. And so these gold prices, the mining companies are generating lots of free cash flow. And with that free cash flow, they pay dividends, and then they also build new mines. And so what at the end of the day, if the gold price stays here or goes higher, what you'll have are increasing dividends, increasing production from part of the cash flow going to building new mines. And then with that increased production, you'll get increasing dividends. So this is something where, gold, again, yields nothing. And with a gold mining company, you're getting that income and the growth that and the growth in income that comes from the free cash flow that the mining companies generate.
Chris, what do you think that upside looks like here for gold?
Well, I mean, I think that if rates, it really depends on where the economy goes. I think that if we have like a soft landing and rates come down a little bit, or the Fed cuts rates to 4.5% or something like that, then I could see gold maybe going to just 2,600 from here, kind of hanging out around this level. But if we see a recession and the Fed actually brings rates down to to where they were really, consistently for like the 15, 20 years prior to this period of high inflation, then I think that there's a really good chance that we could see gold go to 2,800, even close to $3,000 an ounce.
Chris Mancini, Associate Portfolio Manager at Gabelli Fund. Thanks so much for joining us here.
Okay. Thank you.
Well, coming up with a potential rate cut coming in September, are there still opportunities for gains in the bond market? We've got more on that when we return.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Bond traders are upping their bets on a Treasury rally, sparked by expectations of Fed rate cuts. Leveraged positions in Treasury futures rising to a record high ahead of the Fed's annual economic symposium in Jackson Hole. So how big of a catalyst are rate cuts to the bond market? Let's discuss that with Colin Martin. He's Schwab Center for Financial Research's fixed income strategist. Colin, it's great to have you here. So we certainly have seen a rally in Treasuries. I think the question is, what more does that rally look like if we do get a dovish signal on Friday? How do you think the bond market is going to react?
Well, thanks for having me. If the Fed cuts rates as we expected this year, and we're pricing in about 3 rate cuts by the end of the year, we don't think a 50 basis point cut in September is necessary as of now. But if those expectations come to fruition, we continue to expect a bull steepening of the yield curve, where we think short-term rates and some intermediate-term rates will continue to fall. But we're not sure we'll see too much downside with, say, longer-term yields, because if we are still in a soft landing environment, which we think we're probably still in right now, although we're seeing some info that things are slowing, for the most part, the economy is still growing close to trend. So we see less downside for long-term yields, and at around 3.8% on the 10-year right now. We think that's close to fair value. And we expect to see short and intermediate term yields fall a lot more, especially on the short end of the curve. That's the biggest thing we're telling our clients here at Schwab, that once those rate cuts become a reality, short-term yields are expected to fall and reinvestment risk becomes real.
Yeah, and you're seeing yields under pressure as we continue to await these jobs numbers and revisions from the Bureau of Labor Statistics here. But I'm curious about where you can find the best opportunity across the curve, particularly as we do await more information on the path of the Federal Reserve's rate cut cycle moving forward. If investors are looking into bonds, where's the best opportunity?
The guidance we've been providing our clients is to think beyond treasuries. And a key reason for that is because yields have fallen so much over the past few months. We've been talking about the idea of extending duration for close to 2 years now. And by that, we meant considering some intermediate or long-term bond investments, including U.S. Treasuries, because of the high yields they offered. But now with the 10-year yield close to 3.8%, and assuming that the Fed cuts rates but not back to zero, maybe it gets to that 3% area or so, the risk reward isn't as attractive to get into a 10-year Treasury or 7-year Treasury, something like that from a tactical standpoint. So when we say think beyond Treasuries, there's an area of opportunity with investment-grade corporate bonds. You can still get yields there close to 5%. I think that's really important for a lot of investors, a lot of our clients, because 5% is a bogey that they may have in their heads. It's yields you can still get on short-term investments like Treasury bills or CDs or even money market fund yields, but those are temporary. And if you can match that income stream, still get 5% or close to 5% with highly rated investment-grade corporate bonds for a longer period of time, we find that to be pretty attractive right now. So investment-grade corporates are one of our preferred areas to kind of move out of the short end of the curve and lock in high yields with more certainty.
That's exactly where I wanted to go next. Is we obviously know we've still got over $6 trillion sitting on the sidelines in money market funds. Do rate cuts guarantee that money shifts over to bonds, or do you think that there are some consumers, investors, retail investors out there who will still kind of hold off as we wait to see the degree of rate cuts to come?
I think we can see that. We find a lot of investors are slow to react in both directions. And when yields were rising, we saw a lot of investors enjoying the rise in money market fund yields or CDs and T-bills. And even though we got similar yields with longer term investments, they were a bit hesitant to move out because admittedly, a short-term investment with low volatility and high yields is attractive. But the risk is that those high yields, they'll be fleeting and they'll begin to decline. I think what could happen is that investors might be disappointed once those Fed rate cuts come, that intermediate and long-term yields have already declined. We've already started to see that. That's why the yield curve is inverted. So it's a key reason why we've been cautioning investors about reinvestment risk and not just focusing on such a short-term investment strategy. That's what a money market fund investment is. There's benefits to cash investments and money market funds, but not as a diversified long-term strategy. So I think that investors might be surprised that when that rate cut comes, a lot of yields are already lower than they were just 6 or 12 months ago.
All right, Colin, thanks so much for joining us. We really appreciate it. Colin Martin, Schwab Center for Financial Research's fixed income strategist. We're going to get to some breaking news because we do have that breaking data. The Bureau of Labor Statistics revising total non-farm payrolls for the year ending March 2024 down by 818,000. Again, we are finally getting in that data from the Bureau of Labor Statistics, revising down the jobs numbers for the year to a 818,000 level in that prelim revision. Again, the final revision is going to be coming up later in this year. You can see that stocks are moving to the upside at the moment after that fairly large revision. And remember, the estimate was from 300,000 to a million, so coming in near the top of those estimates. But let's get to our panel to walk us through why that data matters. We've got Omer Sharif back with us, the founder and president of Inflation Insights. We've also got Marco Kazaragi, economist and policy strategist for Evercore. And guys, welcome back. We've got the data here. Let's dig through it. Omer, let's go to you first on that headline number. How big of a deal is that?
Yeah, look, it's a bit larger of a revision than I expected. I was thinking more 500 to 600,000 down. Minus 818 is a bit larger. Again, let's just keep a couple things in mind. First is that instead of adding 2.9 million jobs in the 12 months up to March 2024, the economy added 2.1 million jobs. So instead of an average monthly pace of about 242, which is white hot, we still got a very, very solid 175,000 jobs. So that's point number one, is that it's still, despite this big downward revision, that's still a very healthy growth rate in terms of the monthly jobs added to the economy. But I also think the other thing to keep in mind, this is preliminary. So we still get a final revision that will be released in early February of 2025. That'll be sort of the final word on this. So I wouldn't be at all surprised if we were to get a somewhat smaller figure, when all is said and done. But it does show that, the labor market was a bit cooler than what we expected in the 12 months to March. But again, I think the key thing for the Fed is what's happened since then. That's the unemployment rate has risen to 4.3, higher than what they had expected for year end, which is 4%. I think that's going to be the more relevant issue for them.
Marco, taking a look at the market's reaction here, we have the S&P 500. We also have the Nasdaq 100 extending their gains right around session highs following this print here that we're getting from the BLS. I guess, what does this tell us about, is there a risk here just in terms of a more dramatic downshift to the economy? I know we were just talking moments ago about the fact that Fed Chair Jay Powell very much focused on more the recent data that we have been getting. But when we talk about recession fears, does that heighten that risk to any degree?
Yeah, that's a good question. I think, the market got spooked by the unemployment data in July, which interacted with other factors like the decision by the BOJ to hike rates, the extended carry trades. So this created this sort of perfect storm. And after that, market have been very sensitive to daily data releases. So recession fears have been on a little bit of a roller coaster here. But I think it's important to zoom out a little bit in this kind of situation. And I think this is also what the Fed will do. And if you zoom out, you see that the economy is slowing down, but still growing. The labor market is softening, but it's not rapidly deteriorating. And so overall, this picture is more consistent with a soft but bumpy landing than a hard landing. So in this sense, I think that the Fed will, today's data does not change the message that the Fed will deliver on Friday at Jackson Hole.
Omer, can you give us a better idea as to why we're seeing this type of revision, the extent of the revision, the fact that it was overestimated by so much? What are the factors that are driving that?
Sure. Yeah. So again, as I mentioned, a little while back, the monthly numbers are estimates based on surveys, and we cover about 1 out of every 3 employees in the U.S. when we come up with the monthly jobs number. So we're not sort of getting the full picture, but we're estimating based on that smaller sample. And so we also have to make assumptions because we don't have timely data on new businesses that crop up or businesses that might close. And so we have to make estimates for what those numbers look like. And typically those estimates are based a little bit on kind of the most recent trends. And obviously in 2022, we had a lot of business startups. That may have changed a little bit in 2023 in the first part of this year. And so now we're benchmarking to an actual comprehensive count of employment. And so that's why we're getting this downward revision, is because we may have overestimated, the number of new businesses that we're forming and sort of undercounted the ones that were closing. So if you take the net of those, then we probably added too many jobs based off of those sorts of estimates. And now the real count shows us that, in fact, it wasn't quite as robust as what we had initially forecast.
Marco, when you look under the hood at some of this data, particularly the professional and business services sector declining the most under any sector within the benchmark revisions here, it's down by 358,000 jobs. That feels like a big loss for knowledge workers, IT, tech, some of the sectors within the economy filled with people who are fueling some of that negative consumer sentiment about just the state of the economy moving forward. What does that tell you about the job market?
But, as Omar said, like this data is going to be released several times, so I will not focus too much on the granularity of single sectors here. I think it's more important for us to get the overall sign. And in this respect, I also want to stress that this data tends to underestimate the contribution of undocumented immigrants, which are not covered by this survey by a large extent. So probably this overall number that we get in terms of payroll growth tends to be underestimate the actual number of jobs that are being created in the economy. And to the extent that we think that these people are also those that to some extent maybe struggling the most now to keep up with their consumer spending, this data is not that significant as of now. And we have to wait for more data. But by the time, the point is that by the time we get the final data, which by the way, historically tends to be revised up because some state level data comes with a delay. So the number of establishment tends to increase with the revisions, and with that, the count of overall jobs. So by the time we get the final data, this will definitely be stale, and the Fed will have moved forward. And we'll be facing new issues like, new policies by the new administration or something like that.
Sure. Maybe some hope for those individuals out there who have maybe been struggling to find work in the professional and business services sector, given that we are seeing that sector under so much pressure in this data. Really interesting to continue to monitor that. Thank you both so much for joining us. We've got Omar Sharif, the founder and president of Inflation Insights. We've also got Marco Casaraghi, economist and policy strategist for Evercore. Thanks for sticking around, guys. Coming up, we've got more on the market action. Again, markets rallying on the back of these job revisions numbers. Stick around for more. You're watching Catalysts. take a look at NVIDIA, up almost 30% since August 5th as part of a larger tech rally that's brought the S&P 500 index up over 7% in that same time frame. Taking a look at NVIDIA shares right now, up nearly 0.7%. The big question, was the summer's brief pullback a blip, or was it a sign of something further in terms of weakness for the tech sector? Our very own Josh Schaefer joining us here with more. Josh, such a boring morning. Thank God we have you here to talk NVIDIA with us. Something finally to cover.
I've been refreshing the Bureau of Labor Statistics page for 30 minutes, Maddie.
I know.
A lot of fun waiting for those job revisions. But yes,
NVIDIA, yes,
over the last couple days, I've been asking strategists about the rally that we've seen in tech and the rally that we've seen in NVIDIA, and if that is supposed to be worrisome again, right? We've had a lot of conversations over the past year about, well, this rally is only happening in tech. It's 7 stocks leading the stock market higher. That's not a reason to be bullish. That's not a reason to be positive on the current rally. But what strategists are pointing out is that it's more than just tech that has been rallying. Yes, tech has led us from that August 5th bottom, but if you go back over the last month, a lot of stocks have been doing quite well. So our friend Kevin Gordon over at Charles Schwab highlighted a chart to me showing that about 58% of companies in the S&P 500 have been outperforming the index over the last rolling 2 months. This is the highest level that we've seen in the last 2 years. So you can see that big tick up that you see at the end of your screen on that chart. That was the amount of companies outperforming the S&P ticking up over that last month. Another interesting chart that our friend Brian Belsky over at BMO Capital Markets highlighted that was interesting to see is for the first time in about 2 years, you're looking at the rest of the index, not the Magnificent Seven, not the NVIDIAs, Alphabets, Apples of the world, actually outperforming the Mag 7 this quarter thus far. Largely what this tells strategists is this is a healthy bull market. This is what you want to see confidence that stocks are going to continue to chug higher. Largely, people are pointing to the fact that we still have solid economic growth. Yes, we're talking about those BLS revisions today, but still, I think as economists just said to you, we're looking at potentially a soft landing scenario here that would help cyclical areas of the market, markets outside of tech. So largely, the rally we've had, yes, we've talked a lot about tech, but other areas of the market also participate.
Right, and I think that that's kind of been the conversation here, even just going back over the last 12 months, right? Or maybe the last 7-8 months, we want to get more specific. But I guess just in terms of, I think the question is how long that rally is going to last, and more specifically maybe what that upside looks like within some of these cyclical names or cyclical plays, right? Just because of the fact that I feel, at least, there were a lot, comparing the commentary that we're getting today, comparing that to what we got maybe just a month or two ago, there was a lot more questions about tech valuations, a lot more bearishness, maybe that we could see some pressure surrounding tech. Now it seems like people like more of a broad basket of things, but now they are still seeing reason to own tech and buy tech at these levels. So I think the question then is the leadership, maybe how that shakes out, and maybe the participation across the board rather than all of these names instead of tech.
Well, and I think we're having this discussion a week before NVIDIA earnings, and that's going to help you figure out that answer a lot, right? Does NVIDIA earnings bring back sort of more FOMO into the rest of tech? I don't think yes, we saw all of these tech stocks rally over the last 2 weeks, but as you were just pointing out, Shauna, the fundamental story had come a little bit in question over the last couple of weeks, right? After earnings, people are wondering if these companies are spending too much. NVIDIA earnings don't answer that for you. The next couple of weeks aren't really going to answer that for you. The Fed probably doesn't answer that for you. You need to get to the next earnings season to figure out if the companies on your screen right now, like Microsoft, Amazon, Meta, Alphabet, is their AI spending coming back and producing profits that is going to make Wall Street satisfied? That was a looming question we had 3 weeks ago, and we still don't have the answer to. And so I think a lot of people are saying, okay, we've had this rally now. We got to a point where we felt like there was money, potentially easy money or quicker money to earn in tech. And now it's back to wait and see. And so if you want to find other areas where people haven't piled into, that's when you get into those cyclical names. And maybe there's a little bit more room to run there, because remember, it's also a conversation of trying to outperform, right? And so, yes, the tech stocks could still do well, but if there's a chance to outperform elsewhere, maybe that gets us back to our 493.
Right, and that makes a lot of sense. So you should be reading Josh Schaefer's stuff. It's up on the homepage right now, yahoofinance.com. Josh, great stuff. Thanks so much. Let's broaden out the market conversation. We're seeing stocks extend their gains. The S&P 500 near a new all-time high after jobs added for the year ending March 2024 was revised lower by just over 800,000. It's the largest revision that we've seen since 2009, showing the labor market may have been a bit cooler than initially thought. Can the data continue to support the rally? We want to bring in Stephen Dover. He is the chief market strategist, head of Franklin Templeton Institute. It's great to have you here, Stephen. Let's talk about, I guess, just your first take on the revision to the downside that we're seeing, 818,000, and what that implies or what that signals, if anything, here for the equity markets.
Yeah, I think it signals a soft landing. I think the revision is, within the range of what people thought. We were really quite white hot in the jobs report before. We're coming now down to a much more normal economy. We think that means interest rate cuts ahead, probably not as much as the market thinks, but very positive in general for the equity markets as we're seeing right now as the market goes up. In fact, yesterday was a little bit down, but we were looking, as you've reported, a streak of up market that we haven't seen, days up market that we haven't seen for 20 or 30 years. So the market is really taking this as an opportunity. I think what we'll see going forward, and the big shift we see going here, is a move from talk about inflation to talk about growth and increasingly talk about earnings.
I'm fascinated by what we're seeing in the market today, Stephen. So forgive me if I'm being a little bit too elementary here. I'm just curious. We got the data late. We saw stocks ripping. The S&P was just 0.5% away from all-time highs. We're seeing the gas come out of that just a little bit. The S&P and the Nasdaq pairing some of those gains, and the Dow is now under pressure. Is the market moving still off of that retail data? Is it moving off of an idea that the jobs numbers are going to get revised and be a better picture moving forward? What is the defining catalyst for why we are seeing these whipsawing moves in the market today?
It's hard to talk about today, but just in general, I think the market over the last 2 weeks has gone through a catharsis in which it really had an adjustment. It was overextended by leverage. And right now, the market's trying to sort itself out. I don't think this jobs report was particularly important to the market. I think what the market is seeing is we're having a soft landing. Interest rates look like they're going to drop. Earnings look like they're going to be solid at least. And that's good for the market. Let me give you just some data. We looked back at the last 50 years, actually, to 1972, every time interest rates have been cut, and divided those interest rate cuts into two parts. Cuts where we actually had an expanding economy, cuts where we actually had a recessionary economy. Now, in all cases, 1 year later, the stock market's up. But if we're headed into a recession, we get into some really rough times, as we all know, over the first 3 months. But it turns out okay. After a year, the market on average is up 5%. But if we're headed into an expansionary period, which is what we think is the case, once rates are cut, on average, over the last 50 years, the market's been up 17% a year later. I think that's what's driving the market.
So, Stephen, what does this all mean for investors? They're trying to figure out how they should be positioned, how defensive they should be, whether or not some of those cyclical plays still make sense within this environment, given the uncertainty. What are you telling clients?
We are telling clients, let's look back at what we've talked about really for such a long, long time, and that's a balanced portfolio. It makes lots of sense to be in fixed income. If we look at it over the last 2 years, fixed income did exactly what you hope fixed income did, and that's offset the volatility of an overall balanced portfolio. Within the equity markets, we're a little concerned about the equity markets getting ahead of themselves. But that said, we see positive results in the equity market over the course of the next year. Where do you focus? Strong quality companies, technology, industrials, healthcare, energy, and financials, utilities is where we see opportunities. Focus on free cash flow, return on invested capital. That's where we see opportunities. Within the fixed income market, we're a little bit concerned that the treasuries have gotten ahead of themselves. We've been arguing duration for a long time now, and it's just perhaps a little bit ahead of itself. So we're a little bit cautious on jumping in, certainly to treasuries right now.
Yeah, and it certainly looks like treasuries are moving to the upside a little bit off of that jobs data that we are still seeing. I guess the idea that the data is symbolic of a Goldilocks narrative for the economy and not too much softness.
That's where we are. And so what's the risk? Just like we saw 2 years ago. Nobody was reporting the carry 2 weeks ago. Nobody was reporting the carry trade 2 weeks ago. A couple years ago, we had the same problem in the UK. The problem is somebody out there is over leveraged and you don't know what's going to happen at the market at any time. What does that mean for us? We're going to have continued volatility. But when you have these ruptures, which adjusts some of that over leverage, that actually makes the market safer for your typical investor. Another thing to look at, of course, is the dollar. We're seeing the dollar fall as other economies have dropped interest rates prior to the U.S. dropping it. So that is going to be interesting to look at for opportunities outside of the United States.
Yeah, Stephen, thanks for the reminder that this is the part that's fun. I appreciate you wrapping the show with us here. Stephen Dover, Franklin Templeton
Thank you very much. Thank you very much.
Chief Market Strategist. Thank you. We're going to continue to have all of your markets action ahead, so stay tuned for more. You're looking at a mixed picture across the board. The S&P and the Nasdaq just about flat here. Let's do a check of the markets here. You're still looking at gains across the S&P and the Nasdaq, but just moving above where we just saw them really whipsawing around. The Dow is under pressure here, and you're seeing yields ticking up across the curve. When you take a look at treasuries here as the market digests those jobs revisions coming in lower than anticipated. Well, I mean, towards the end of where they were anticipated. It was a big range here, but the market, I guess, viewing this as a Goldilocks narrative to come, Shauna.
It'll be interesting to see what the market action is for the rest of the day. Well, coming up, we've got Wealth that's dedicated to all of your personal finance needs. Brad Smith, he has you for the next hour. Stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, we're going to talk all about what the latest retail earnings say about the state of the consumer and preparing for unemployment. A New York Fed survey shows a record number of people think they'll become unemployed soon. We'll have an expert break down how you should prepare for unemployment if that bite bugs. Plus, or bug bites rather. But anyway, plus, NVIDIA reports earnings next week, the all-anticipated bellwether, as it's been called, of the earnings season. But in the meantime, we'll get you prepared with the best semiconductor ETF plays for your portfolio. All and that much more during today's show. Let's get back to the consumer, though. You, me, everybody. Consumers are increasingly going digital and looking for deals, as evidenced by earnings reports from retail giants Target, TJX, and Macy's. The Wednesday morning releases all provided more insight into the consumer mindset and the ability to spend. Diving further into the data with her own prognosis, we have with us in studio Jerome Martis, LSEG Director of Consumer Research. Jerome, great to have you here with us on the program. So first and foremost, you look across these reports. Is there one common denominator that really jumps out about the consumer right now?
Well, good morning, Brad. There are two common denominators right now that are jumping out. The first one being that, as you mentioned, retailers are all about the omni-channel strategy, and this is what's important in order to attract the consumers to the stores. Home Depot, Walmart, Lowe's yesterday all told us, and even Target today, they smashed their e-commerce estimate with a robust 8.3% growth in e-commerce. Consumers are ordering things on their mobile phones and then wanting to pick them up in store on their way from work to home. And so this is really what's driving sales, not only at the big retailers, but also with U.S. retail sales. The second trend we're seeing is that consumers are extremely value-oriented. Yeah. They are shopping at the discounters, off-price retailers. We're in a time when we're receiving a lot of negative guidance. We saw TJX telling us today that actually the third quarter is off to a great start, when other retailers are telling us not to expect too much from them for the third quarter.
So of the retailers that we've continued to hear from over the course of this earnings season, and there are still a few more to trickle out, but we've heard Walmart say that even the higher end consumer is trading into their company. Is there a company that is best positioned right now given the deal hunting, the value hacking that consumers are doing?
Well, there's one particular company that analysts polled by IXIC are bullish on. In fact, our StarMine data tells us that this company is likely to beat earnings estimates next week and post a positive surprise. And this is Gap, because of its Old Navy division, which is a big winner right now for parents who are, no matter how the economy is doing, back to school happens every year and parents are budgeted for it. They are looking to save money, and Old Navy is able to do that for them. So as a result, that's one particular company that we are bullish on. And then teen retailers Abercrombie and American Eagle have a very loyal following for the back to school season. So those are the three names that we're watching next week.
It seems like right now that the best smart shopping habits that consumers are starting to deploy is being very choosy about the deals and waiting for deals. That propensity to wait, that's going to impact companies' bottom lines. That impacts the inventory that they're able to move through. So of the people, or of the consumers out there that are, like you and I were talking about before we even came on set, waiting and keeping things in their shopping cart and just waiting for that price to trickle down and move lower, where are we bound to see more of those deals start to come to light as well?
Well, definitely. So the trend this year has been like you saw July retail sales were, really smashing expectations. And that was because the average promotional rate and the amount of merchandise on sale really spiked to the highest level it did all year round. So we're going to continue to see things like this around Labor Day weekend. Already people are shopping for Halloween. I just spoke to your makeup artist. He's already shopping for Christmas holiday season. So people are already eyeing what is on sale now, putting it in their closet and saving it, for those later moments. But make no mistake, the consumer is only opening up their wallets if they see that there's a discount. Home Depot told us that they are thinking twice about those big ticket items. Over $1,000, they actually were down 6%. So consumers, if they're opening up their wallet right now, it's just for the things that they need, like apparel for back to school and items like that.
Yeah, that's really interesting. And I mean, look, I can't really say too much because I too did shop early and it ultimately is perhaps my first Amazon purchase ever, my Halloween costume, just to make sure that I had it.
What is it?
To be revealed. But as we're continuing to watch right now with consumers, the ticket itself is also decelerating, moving lower, declining, I should say, actually. What do you make of that?
Yeah, absolutely. Even in today's targets numbers, right? They told us that consumers did open up their wallet for discretionary items, but they were gravitating towards the private label items that are at a much lower cost point. So if they are opening up their wallets, it's for the discounts, the lower price points, and they're thinking twice anything above $1,000. And we also heard that they're not refinancing for big renovations from Lowe's or Home Depot.
It seems like we're going to be staring down like a private label war. We were speaking with TD Cowen's Oliver Chen earlier today, who said Macy's also needs to get its private label right. Is there a private label that's really outperforming from your perspective right now?
Walmart and Target, and then it's not a private label, but consumers still want designer for less, and that's where the off-price retailers like Ross and TJX didn't only do well for the second quarter, but are projected to continue to be the winners for the second half of the year.
Okay, you didn't say Kirkland. That's interesting here. All right, we're going to have to continue this conversation. Jerome Martis, LSEG Director of Consumer Research. Great to see you.
Good to be here.
Thanks. Well, economic readings out this month suggest people are doing all right, but are they? That's a big question. 60% of Americans are living paycheck to paycheck, according to the latest Debt.com survey, and that's despite their budgeting that they are doing. And Legal Shield's Consumer Stress Legal Index, which tracks consumers seeking legal assistance for foreclosure, bankruptcy, consumer finance issues, what have you, rising nearly 6 points in July. That's the highest reading since November 2020. So, to discuss how people are feeling, we have Matt Layton, who is the Legal Shield SVP of Consumer Analytics. Matt, great to have you here with us. So, why do you think we're seeing this jump in people looking for legal assistance right now?
Hey, great to be here, and thank you for having me on. And you hit it right on, right? We saw the largest jump in several years, and really the highest single month since the beginning of our index. And really, we're looking at consumer finance issues, right? People are calling us for legal assistance for consumer finance, bankruptcy, foreclosure. We've seen a big jump in that in July.
And so with that in mind, and we're taking a look at the reading for the legal stress index here, where are more people trying to deploy those legal services towards, especially as they're trying to tackle debt?
Right. So, I mean, the legal needs of millions of everyday Americans, I think, gives us a unique insight in their economic stress. So really, it's those issues around consumer finance. I mean, do I pay my rent now or later? Should I make my mortgage payment? What happens if I'm late? What happens if I don't pay my car bill? The consumers are feeling the stress of long-term increased rates of the inflation and the interest rates, and we're seeing that in the requests for legal services we see on a monthly basis.
You know, it's interesting too, because the consumer reaching out for legal services would also suggest that, similar to what we were seeing within the Debt.com survey and data that they put out, that people are trying to get ahead of where they might run into some issues. Do you think there's a massive shift in the mindset of how consumers coming out of the pandemic and coming out of revenge travel and now getting into a little bit more of, okay, we need to budget, we need to plan out our financial future, that there's a shift in that mindset to correctly set themselves up for being able to navigate some of the issues that they're foreseeing?
Sure. We like to say people don't call a lawyer for a good time. They call because they've got a problem and they're looking to improve their situation. And that's exactly what we're seeing. Over 150,000 times a month, consumers are calling our provider lawyers for help for legal issues. And specifically in July, we saw a large increase in those types of issues, again, around consumer finance, bankruptcy, foreclosure.
And so with that in mind here, how could the housing market that we're seeing right now, because the anticipation is that if we see mortgage rates continue to trend lower, then that could mean even more, for a good reason, even more demand for legal services as people try to work through long contracts in order to make sure that they're getting to and through closing and settlement on those homes. What are you anticipating there?
Sure, especially in terms of the new agreements between the commissions paid to realtors. So like you said, positive and negative. Interest rates are still high, especially some of those mortgage rates in the last several years. So people are going to continue to be concerned about paying those mortgage rates. But as we see interest rates come down, we do expect to see a larger volume of calls regarding real estate closings and real estate transactions and how the consumer can get the best deal for themselves.
Matt, really valuable insights here. Thanks so much for taking the time here with us. Matt Layton, Legal Shield Senior Vice President of Consumer Analytics. Appreciate it.
Thank you.
Certainly. Coming up, new surveys show many people are bracing for unemployment. We're going to dig into how you can financially prepare in the event of the loss of a job. U.S. payrolls were revised lower by 818,000 jobs for the year ending March 2024. The figure came in on the upper end of economist estimates. The fresh data also comes ahead of an expected rate cut this fall. And it could fuel more uncertainty about the health of the labor market, and Americans themselves are seeing their own job prospects potentially decline. 70% of employees are bracing for layoffs, according to a MarketWatch survey. And so if You're part of that majority. We're breaking down how you should prepare for potential unemployment. To discuss, let's bring in Blair Duquesne, who is the Ritholtz Wealth Management Investment Advisor. Blair, great to have you here on the program with us. All right, not fun to talk about layoffs and unemployment, but all the more important for preparedness as well. What is step one for how people, if they do find themselves as no longer part of the labor force or temporarily out of the labor force, can do to ensure that there's a pathway back in and that on the financial side, they're managing their prospects and their finances correctly too?
Yes, and thank you for having me, Brad. I'm sorry we have to talk about such a downer topic, but it is good to be prepared in advance. So, rules of thumb for financial planning are you want to have at least 3 to 6 months of your living expenses in a cash reserve. That's cash savings in the bank, not invested in markets, not locked up in CDs. You want to have that cash available. I know a lot of Americans are living paycheck to paycheck, but the time to prepare is before the layoff happens, right? So ideally, the 3 to 6 months in a cash reserve would be the goal that we're looking to accomplish.
Certainly, and as we're taking a look at some of those tips on the screen here right now, a lot of people may be wondering, okay, what are some of the most vulnerable sectors right now that we're seeing in terms of the layoffs that have already come forward and those that are anticipated?
Yeah, so with an economic downturn, pretty much every sector of the economy is going to be impacted. I would look to the areas where maybe there was a little bit of overhiring in the job spree that we had post-pandemic. Obviously, we saw some layoffs in the tech sector a couple of years ago with the downturn in the market. But I think everybody should be prepared in case of a job loss because an economic downturn does hit everybody.
And so with that in mind, I mean, as we're continuing to watch the labor market here, the unemployment rate and the overall monthly jobs gained, jobs added, that's typically that headline figure. But where else should people be really pouring into and looking through these reports to get a sense of the health beyond those headline numbers?
Well, the job market has softened quite a bit. It was way too tight a couple of years ago, but it's still strong. Our unemployment rate is still at fairly low levels compared to the historic analysis. So you got to look inside your industry and see, where cuts may be coming. But the good news is, we've got a strong economy right now. It might be softening, but you'd rather probably get laid off earlier in the cycle than later because the chances of finding a job pretty quickly now are pretty high.
And so with that in mind, finding a job, getting back into the workforce, what is the thing that people should remember as they're looking to reestablish themselves within the workforce?
Personal networks, I think, are the key today. Their resumes are a dime a dozen. Spray and pray. If we list jobs on the internet, you're going to get thousands of applicants. It's really hard to stand out. So I do think that hand-to-hand combat, working through your personal network to try to find jobs, is probably going to be the way to go.
Blair Duquesne, who is the Ritholtz Wealth Management Investment Advisor. Thanks so much for taking the time here with us, Blair. Appreciate it.
Thanks so much for having me.
Certainly. Well, NVIDIA's earnings, they're out August 28th. If you don't have NVIDIA cash, we can break down how you can invest in the semiconductor trade through ETFs. That's right after the break.
The Federal Reserve has a dual mandate: maximum employment and price stability. And when it comes to the latter, there's one number the central bank targets: 2% inflation.
The economy has made considerable progress toward the Fed's 2% inflation goal.
The Fed maintains the economy can run efficiently when inflation remains low and stable over the long run. But why 2%? Here's how 2% became the Fed's inflation benchmark and why some want that number reconsidered. The 2% target is widely adopted by all major central banks today, but it was the Reserve Bank of New Zealand that first came up with the idea back in 1988. The finance minister at the time was facing pressure after years of double-digit inflation.
He was doing an interview as it was getting under 10%. And what happened is the interviewer just asked him, what should the target be at the end? And he just responded to it. So it was this apparent off-the-cuff moment and wasn't intended to be setting policy, even though it did.
New Zealand set its initial target range between 0 to 2%. Other central banks quickly followed, but the Fed didn't officially adopt an inflation target until 2012.
This 2% goal for inflation over the longer run should help foster price stability and moderate long-term interest rates.
There was a time
when Fed policymakers attempted to cultivate an air of mystery and cloak their statements in ambiguity. Really, the person who turned that thinking around was the one-time Federal Reserve Chair, Ben Bernanke. He was at the forefront of a revolution in thinking that being clear about what your objectives are, communicating crisply and understandably to both financial market participants and to ordinary households and businesses about exactly what you're doing and why you're doing it, that promotes the objectives of monetary policy. It helps monetary policy be more effective.
The idea is to create predictability and certainty. When consumers and businesses know where the Fed wants inflation to be, it allows them to plan for the future. It gives them reasonable confidence about where prices are going.
You say what you do, you mean what you say, and you execute according to plan. That builds credibility, and credibility in turn has two key effects. First of all, when inflation takes off, financial market participants, households, businesses all have confidence that you're going to bring inflation back down to target. Secondly, when the economy weakens, goes into recession, people are losing their jobs, you have the latitude to battle back against that.
Economists say anchoring that target to 2% gives Fed officials flexibility to maximize its tools.
The Fed's key tool in fighting recessions is to cut interest rates. And so you want a little bit of a buffer for the Fed to be able to cut interest rates when times are normal, so that if the economy tips into recession, there's room for the Fed to take action against it.
That hasn't always worked. Persistently low inflation prompted the Fed to significantly tweak its policy in 2020 through something called average inflation targeting.
It says instead of having to hit 2% exactly, the average can be about 2%. So in other words, inflation can run a little hotter at times if it runs a little cooler other times.
Stubborn inflation coming out of the pandemic has reignited the debate over that 2% number.
Is there substantial economic analysis that argues that your target rate and the economy would work better if we had a slightly higher target than 2%?
2% has become the global standard. It's a pretty durable standard. I don't have any reason to think that it's a problem for the United States to get to 2% inflation.
The criticism from the left is that it puts too much emphasis on this and there's not a target on the labor market side. For instance, there's no unemployment target to balance a price target.
Republicans have largely been supportive of the 2% target. The Fed reviews its monetary policy framework every 5 years. Officials have vowed a thorough public review of its policy strategy, tools, and communication practices in 2024. But economists aren't holding their breath for major changes anytime soon.
The benefits of inflation targeting, the benefits of this approach to monetary policy, which features predictability, credibility, accountability, that has really paid enormous dividends. As painful as the inflation of the COVID era has been, it would have been tremendously worse if we'd had to pay the cost in the form of much higher inflation, a deep recession, in order to bring that inflation back down.
NVIDIA earnings are out next week. The semiconductor sector as a whole is up by about 20% year to date, just over that. And the earnings report for NVIDIA could bring it to new highs. But if you want to play in the semi space without having to cash into specific names, then you might want to look into some sector ETFs. For more, we have John Mayer, who is the JP Morgan Asset Management Chief ETF Strategist, as part of the ETF report brought to you by Invesco QQQ. John, great to have you back in studio here with us.
Thanks for having me.
Absolutely. So let's talk about this. I mean, of course, this is one of the bellwethers for the earnings season, but it puts a spotlight back on the semiconductor industry once again. For those who are looking across sector-specific ETFs, are there other ETFs that have specific weightings and look across these components that you are keeping at the top of your docket versus others?
Yeah, I first of all, I think it's important for the industry to have a bellwether post these really strong earnings. And if you think about all the kind of the downstream implications for all the suppliers, all the, where are the GPUs stored, right. Data centers, how are they powered, energy, utilities. So there's so many downstream implications from these large semiconductor names that are coming out with these strong earnings. We're in the beginning stages of generative AI, and a broad-based ETF that has exposure to a swath of names, I think is certainly a way to go, to diversify your exposure.
How risky is that when you have one name that is having an outsized buoy effect on the industry as well?
There's so many downstream positive implications, like I had mentioned. The suppliers, all the suppliers that are these large bellwether names are, it's really important. And again, you have who's benefiting from generative AI. We're in inning 1 or 2 of generative AI, right? So if you think about like the smartphone value chain, there's so many downstream implications. And if you actually make some comparisons to the smartphone, came out 15 years ago, people are like, what do you do with this? Well, apps, all of the cases that go on, these are all industries, multi-billion-dollar industries that were created around that ecosystem. I think that's a better comparison than, say, like the dot-com bubble. This is not a dot-com bubble from my perspective.
Interesting. And so are there ETFs that you're tracking that can ride on the semiconductor coattails right now?
There are certain ETFs out there, but I think an active management approach is really the way to go. So if you look in the growth area, you look at an active manager, they are going to have exposure to semiconductor names and the ecosystem surrounding it and all the companies that provide data for generative AI. I think that's really important. So looking at bottoms-up research, I think is a way to go. And at JP Morgan, we do focus on actively managed ETFs. And I think that's the place to be.
It's so interesting, especially because if you kind of do this, hub and spoke, and you put the spokes out there to say all of the things that are also beneficiaries of generative AI as this hub. You've got cybersecurity, you've got data centers as well. You can layer in even energy that's necessary to supply to the data centers. So all of these things considered, there are those different spokes. Are there certain areas that you're seeing investors really gravitate towards?
Yeah, I think data centers is an area investors are gravitating towards. Utilities are really interesting. In a declining rate environment, utilities tend to do better because there's less yield options out there. This environment, I think many different sectors, in particular utilities, are adapting themselves to the current environment. And that's providing the massive amount of energy that's required for these data centers. And that's only going to increase over time.
Well, yeah, especially if we get to what has been expected to be at some point a 1 million chip data center. We'll see when that comes to fruition. Right now, we're still at about 60,000. Still a mind-boggling number. Yes. John, great to see you. Thanks so much for joining us in the studio.
Thanks a lot.
John Mayer, who is the JP Morgan Asset Management Chief ETF Strategist. Turning now to drama in the AI world. AI startup Anthropic is facing a copyright lawsuit from a group of authors claiming it used pirated copies of their books to train the chatbot Claude. This is just the latest of legal battles in the industry as lawmakers attempt to legislate the industry. And one California lawmaker is proposing a bill to lay out the guardrails for the safe development of AI, but he's facing plenty of pushback from those companies. Here with the latest on this, we've got our very own Akiko Fujita. Akiko, what do we know so far?
Yeah, Brad, this is a bill that's being closely watched in part because major tech firms developing AI are all based here in California. So companies like Meta, Alphabet, OpenAI, and Anthropic, they would all be bound by any state law that's signed. So any changes to the way they operate would have broad implications for their technology. Other state and federal lawmakers are also watching this one closely to see if California sets the standard for others to follow. Remember, there is no federal law on the books right now that sets guardrails for AI developers, just an executive order that was signed by President Biden last year. So here's what SB 1047, which is what this bill is, spells out. As it stands, it would require companies to test the safety of AI technology they're developing before releasing it to the public. The firms would be required to grant the state attorney general access to the unredacted safety and security protocol in addition to reporting each AI safety incident. The bill would then also give the attorney general the right to sue companies if their technologies caused serious harm. Now, the bill is expected to pass the legislature by the end of the month. Governor Gavin Newsom has not said if he plans to sign it into law, but the bill's author, California State Senator Scott Weiner, has faced plenty of pushback from critics who say the proposed law stifles innovation. Now, opponents are concerned that the threat of legal action would discourage larger tech companies from open sourcing their technology, sharing the underlying software code with other developers. And the result, they say, would hurt smaller startups who are building on the work of big tech firms. Supporters like former Google researcher Jeff Hinton, who's also known as the godfather of AI, says these guardrails are critical to prevent disasters at a time when companies are chasing profits over AI safety. Now, we talked about the pushback that the state lawmaker faced here. Since then, he has amended the bill to bring into consideration some of the criticism of that. Now, 8 state lawmakers have already urged Governor Newsom to veto the bill. You've also got congressmen like Ro Khanna, who represents Silicon Valley, saying this just isn't the right approach. But remember, Brad, it was just last year that we had CEOs, those like Sam Altman from OpenAI, as well as the CEO of Anthropic, testifying before Congress, urging lawmakers, at least in D.C., to regulate the industry. So some are saying, look, what is this about face that we're saying? The argument on one side would be that the state isn't where laws should be set, at least on the issue of AI. But we're talking about the end of the month next week. So we'll be watching this one closely to see if, in fact, it does pass the legislature, which it is expected to, and whether, in fact, Governor Newsom does sign it into law.
All right. I know you'll be all over that one, continuing to track the latest developments there. Akiko, thanks so much for the update here. Appreciate it. Coming up, everyone, it's never too early to get started on your year-end tax planning. We'll explain why when we come back. The New Year's ball drop into 2025 may seem like a long time from now, but our next guest believes that it's never too early to get started on your year-end tax planning, and neither do I. Here to tell us how you can get a jump start is Judy Brown. She is the SC&H Wealth Principal and Wealth Advisor, joining us here on set. Great to have you here in studio with us.
Thank you. Thank you for having me.
Okay, so never too early to get started here, but if you are trying to get started early, where should you begin? Where should the mindset really kind of set a step one for your tax preparation for 2025?
Absolutely. So right now, I think it's just understanding what year-end tax planning is.
Okay.
And basically, tax planning is taking people's personal goals, financial goals, and integrating whatever the current tax laws are to find a tax-efficient way to achieve those goals. So I think first step is looking at what your financial goals are, and then taking a look at your tax returns more carefully. So right now, looking at, we're in September, so it's a great time to hone in on 2024 taxes before the year wraps up. Some things people could do would be to take their 2023 tax return and start to update it with preliminary numbers. We don't have final numbers, but maybe their income's a little higher this year. Maybe it's going to put them in a different tax bracket. Maybe they've had some medical expenses, so they're going to be itemizing, whereas maybe they didn't last year. So at this point, they can start to gather, take the time. It's not fun, but they can take the time to gather the documents, mortgage interest statements, all kinds of things, and just start to plug it in. And that's where the help of a tax professional or a tax advisor can really help. But it'll identify, have they paid enough in this year to avoid a tax penalty? Are they on track with their retirement goals and tax efficiency? So that's kind of the first step right now, I'd say.
I mean, is there any significant change in the filing process that we're anticipating between 2024 and 2025 at this juncture?
Interesting, not so much between 2024 and 2025, but between 2025 and 2026, we are expecting some big changes. And that's because the Tax Cut and Jobs Act, which was signed back in December of 2017, expires or sunsets, at least a lot of the provisions. And some of those provisions are pretty significant. And one that's been talked about a lot is the annual or the lifetime estate and gift exclusion, reducing to about half. But the one that's going to really affect most people, the things that are going to affect most people really is about the tax rate, the top tax rate going up, all the tax brackets shifting. Like the top tax rate is going to go from 37 to 39.6%. The standard deduction is going to go in half. So people that weren't itemizing, that were not itemizing before might be now. So that's when we're going to really see a lot of tax planning that will be very valuable.
Okay, so with that in mind, I mean, we're in the midst of convention seasons. The RNC, we've got through that, now the DNC, and we're hearing a lot more talk from both sides of the aisle about what potential changes could be put forward that have impacts to tax code and legislation that could come forward. Is there anything that voters, people who are filing for their taxes, should be paying close attention to and listening for?
I think they definitely should be paying close attention and trying to see how it's going to impact, again, their personal goals. And that's where if they can start now with doing tax projections, it's not a 1 year, it's a lifetime of understanding your tax efficiency. And so if they can start to do that, then they'll be prepared by maybe running it if the Tax Cut and Job Act sunsets versus if it doesn't. And then they can make decisions more easily, more quickly, depending on what happens.
Absolutely. Judy Brown, she is the SC&H Wealth Principal and Wealth Advisor. Thanks so much for taking the time.
Thank you very much for having me.
Absolutely. Coming up, everyone, do you need help getting ahead and making a name for yourself at work? We've got you covered with tips from a business expert next on Wealth.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say NVIDIA is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market cap is currently hovering at around $3 trillion. Let's take a closer look at what led to NVIDIA's boom with Beyond the Ticker, where we dive into the company's biggest moments. NVIDIA was founded on April 5th, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, NVIDIA launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, NVIDIA went public via IPO at $12 per share. And in 2000, Microsoft chose NVIDIA to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose NVIDIA's hardware to power the PlayStation 3. In 2010, NVIDIA became the graphics chip supplier for automaker Audi. And in 2015, the company launched its NVIDIA Drive chip for powering driver assistance technologies. In 2016, NVIDIA kicked off its AI efforts with the launch of the DGX-1. 2 years later, the company debuted NVIDIA RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using NVIDIA's Tesla P4 graphics cards for its Google Cloud platform. In 2022, NVIDIA debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. On June 5th, 2024, NVIDIA eclipsed that $3 trillion mark, joining the ranks of mega companies Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading well over $1,000 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, NVIDIA remains at the top of the tech industry.
We're tapping in with a leader in business to get some tools, tips, and tricks for building wealth, advancing in business, and much more. We've got Matt Higgins here with us in studio. He is the CEO and co-founder of RSE Ventures, a company that has backed brands like Resi. I used to use them back in college. Pizza, excuse me. And we've also got Magnolia and Bluestone Lane. I mean, these are like household known names, Matt. He's been a recurring shark on the TV series Shark Tank, featured in multiple episodes, seasons 10 and 11. Matt, great to have you here.
Thanks for having me. I do pick well.
Let's talk about this. I mean, you've got so many different businesses. You were also with the Miami Dolphins organization, vice chair. Yeah. So this is essentially kind of such an interesting environment for finding capital for entrepreneurs. And I want to start there because it's difficult for a lot of businesses to prove that they are worth the capital that they need and that they're seeking to keep their business afloat amid this macroeconomic backdrop. What is a successful pitch right now sound like to you?
Yeah, we're in a fascinating time because if you look at NVIDIA and the stock market, you think everything is booming, but the reality is the private markets are still seized up. And it's almost like everyone's waiting for the other shoe to drop because the valuations are not realistic. And so my number one piece of advice is return to basics, right? If you could build a business that you could demonstrate is going to be profitable or already is profitable, it is a lot easier to get funded. So throw your old assumptions out the window. I'll give you an example. Consumer goods, consumer packaged goods used to trade at 5 to 7 times top line, not anymore. So the safest thing you could do as an entrepreneur is you have to have a vision for sustainability.
What do the traits of a successful entrepreneur look like to you?
I think it's somebody who I believe will pivot. When you present a deck, 5 years later, the business you build has nothing to do with that deck, barely resembles it, right? And if it does, you probably have a problem. I'm looking for somebody who can demonstrate they have the self-awareness to make course corrections, right? Things aren't working, and they have the confidence and humility to acknowledge it. The universe is benevolent. It's going to give you multiple opportunities to change direction. Are you going to take the opportunity is the big predictor of success or failure. So when you're meeting an investor, make sure you're using words like we, not I.
Yeah.
Make sure you're willing to acknowledge you don't have the answers to everything, but you're the kind of person that will figure it out.
You started to get at this a little bit, but what are the red flags on the other side that you see in entrepreneurs and investors that make you not want to work with them?
I mean, blamey people. People who have who believe that they don't have agency, that they're not the ones who did it. They use words like I a lot. You'd be shocked how many people just can't bring themselves to say we. So the number one flag I see are people who tend to shift blame away from themselves as opposed to assuming responsibility.
Okay, so let's switch gears here. Let's talk a little bit of what we're seeing more broadly here for people who are just trying to build wealth, households that are trying to build wealth. Is there a square one that households can really kind of rally around to say, here's how we chart our path towards wealth?
Yeah, first of all, time is your friend, right? Time is the number one asset that all of us are given. It's a blank slate, and we tend to treat time as our enemy, or we waste it in the beginning. So to young people out there, you want to make sure you realize if you had put money in Google at the IPO in 2004, you would be a millionaire today with $10,000. So use time, make it your friend. In terms of investing, you want to be in the stock market at all times, but you want to identify tailwinds that are so strong that they're going to overcome macro headwinds. So the recession, we're going to have one soon, right? What concepts are so strong that they're going to still do well in a recession? I believe obesity drugs are going to perform phenomenally well. It's just something I'm passionate about. You want to identify those macro themes that are going to be so powerful and then put your money behind those.
I want to get back to the obesity drug call, but the recession call that you're mentioning, with relation to past recessions that we have seen, what type of severity do you believe that this one may have?
I'm an outlier. I think it's going to be pretty severe and very sharp. The reason why is the math isn't mathing. At the end of the day, Americans are laboring under a record amount of debt. Credit cards are ticking away at 25%. We've had signals, two signals in particular. One's called the Sam rule. We don't have to get into it, but it has always predicted every recession. It was hit last month. So I think it's going to be intense. It's going to lead to higher unemployment than people are forecasting, but it's going to be short and intense and then begin to resolve itself. And AI will be the technology that will deliver us to the other side.
And we've had Claudia Sahm on to discuss that Sahm
Now
rule
she doesn't,
as well.
and she doesn't actually think, she's not sure because it was a hurricane. I think that might be some wishful thinking, is my opinion.
We did see the BLS put that note at the top of that monthly report to say that there was a weather event and that they didn't see any major impact.
I do think it's kind of fascinating to be the author of a rule, and then you're like, but the rule might not apply right now, so we'll see how it shakes out.
Certainly. Just lastly, while we have you here, and you mentioned weight loss drugs, so we're going to come back to that. And I'll kind of broaden it out and say the largest themes right now. If there were 3 top themes that you feel confident investing in at this juncture, what would they be?
Okay, great. So number 1, obesity drugs, GLP-1. Stock I love is called Viking. You can look it up. Number 2, energy. Data centers are exploding. You don't have to believe in AI to believe that data centers are exploding. So energy. So what happens when you start building data centers? Copper. So those are, I'm giving you 3. Those are the ones that I'm investing in. And then what I believe is you identify those tailwinds and then you pick the best players within those tailwinds.
Matt Higgins, RSC Ventures, CEO and co-founder. We could go through all the rest of his titles, but we'd go over our allotted time here for the show. Matt, great to see you.
Thank you for having me.
Thanks so much. Everyone, let's do one final check of the markets here as we're taking a look at the major averages. We've been keeping them flashing across the bottom of your screen throughout the show, but here's a blown up look at it. The Dow Jones Industrial Average right now, flat just barely to the downside. It's slower by about 0.1%. Holding on to gains, though, you've got the S&P 500 up by about 0.1%. We'll be generous and round that off too. About the same on a percentage basis. The Nasdaq Composite still in the green right now. We've had a slew of retail earnings come out over the course of today and this week, really rounding out some of the viewpoints from CEOs of that sector, and we'll continue to get more as we move on throughout the rest of this week. Let's also just take a quick look, if we may, as we're taking a look at these U.S. major averages at the bond moves that we're tracking here as well here, the 5, the 10, and the 30, as we've been keeping a close eye on that as we've got the, okay, we're not going to go over to that, but anyway. We'll take a look at that a little bit later on with our heat map. Everyone, that's it for Wealth. I'm Brad Smith. Thanks so much for watching. You've got Market Domination you can stay tuned for. Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern Time. You don't want to miss it.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.